as the biggest risk right now that's driving them into cash. Meme stock massacre. GameStop is down almost 45% in just a few weeks. AMC's loss since early November is 48%. Where have all those retail traders gone? And Snack Attack, pretzel and chip maker Up seems to be the fastest growing snack maker at scale, but investors don't seem to be getting the message. We're going to talk to CEO Dylan Lissette about his efforts. But first this morning, we want to bring you the latest in COVID headlines here. The latest data coming from Pfizer, both about vaccinations and their success rate against Omicron, as well as treatment pills for COVID. Our Anjali Kamlani is here with the latest and what we're hearing from Pfizer. Anjali, good morning.
Good morning, Julie. That's right. Some good news from Pfizer this morning. The pill that they have been ready to submit to the FDA for an emergency use authorization just proved to confirm the initial results that they had released last month. So right now they're looking at 89% effectiveness against the virus, and that's in high-risk adults, as well as 88% effectiveness for overall individuals that were in the study. And that is really for a 5-day course, and this provides protection against hospitalization and death, which of course is the ultimate sort of prevention that is needed from a pill like this. Right now, they are waiting for word from the FDA on accepting this data and whether or not that EUA will come through. Just as a side note, Merck, which also has a pill to fight COVID, it had less effective results, has already had an FDA advisory committee meeting, but no ruling just yet on whether or not that pill will be accepted. Meanwhile, Pfizer also has some good news coming out of South Africa, which we know saw a significant surge recently, and the vaccine has proved 70% effective against the Omicron variant, according to a study from South Africa. So that is proving, the case for what we're waiting to see here in the U.S. Back to you.
Anjali, this comes alongside, this bit of positive news, I should say, comes alongside of really rising cases globally as it pertains to Omicron.
That's right, Brian. We know that globally cases continue to drive up, and especially looking at areas like South Africa that just saw a surge, the African continent in general reported an 83% surge in new cases this week, and really all eyes there, as well as in Europe, where we know that Omicron is spreading. Right now, we've got more than 270 million cases globally, as well as more than 5.3 million deaths. Here in the U.S., that number is more than that number is 50 million cases. That is a significant milestone that the U.S. has reached. And we also know that, of course, unfortunately, the death toll has surpassed 800,000 this week. Back to you.
And Anjali, finally, another thread that we're following in all of this are the various vaccine mandates, particularly for healthcare workers, because even as we had a mandate in New York stand for healthcare workers, they're not standing everywhere.
That's correct. We saw last month, we saw the ruling from a Missouri federal court, which basically blocked the Biden administration's attempt to require vaccines for all health workers, and that was through the Centers for Medicare and Medicaid Services. That block affected several states, and so as a result, we've seen sort of this easing of vaccine mandates in some major healthcare providers, especially those that operate in multiple states, as that includes larger industry corporations like HCA, as well as some nonprofits like Advent Health and the Cleveland Clinic. We also have seen this really affect hospitals as a result of the labor shortage. They're battling that right now at the same time, and so the loss of any healthcare workers, be it nurses or janitors, they've all been across the board really crunched for labor, and so that is really part of the issue and part of the reason why some of them are giving to reduce that mandate, even though we have seen at least 42% of hospitals have some sort of mandate in place, according to the American Hospital Association. And we've also seen some concerning numbers, some areas more than others, of course, where unvaccinated remain pretty high.
Yeah, definitely something to know about if you are going in to get health care in these various places. Anjali Kamlani, thank you so much. Appreciate it. Now let's switch to the investing landscape and what we are hearing in the monthly Bank of America Fund Manager Survey. There are a couple things that really stand out. One of them is how these fund managers are positioning here, because we are seeing unusually high cash positioning. Now, just a reminder to our viewers, when we say cash, we don't mean actual dollars necessarily. It's usually cash and short-term equivalent, so short-term debt, for example. But it's where fund managers tend to go when they are feeling nervous. And cash positioning is now at 5.1% in this survey. You can see it hasn't been at that level in quite some time, in fact, since May of 2020. So what does that mean? Well, according to Bank of America, it triggers what they call their FMS, Fund Managers Survey, cash flow. It's a buy signal, in other words, sort of a contrarian signal that people are getting more concerned here. So that's interesting, Saz. And I know for you, not only did that catch your eye, but also catching your eye was how positioning is changing more broadly and why it's changing.
Yeah, and you're also seeing outside that rotation to cash, Julie, you're seeing investors rotate, an institutional investor, I should say, rotate into defensive areas in the market. Healthcare, also according to the survey, REITs or real estate investment trusts, which I'm surprised to see that rotation into, given these are normally interest rate sensitive stocks. And obviously, of course, next year we might be getting several rate hikes from the Federal Reserve. But I will note this too, there's a flip side to this coin. If we do get a dovish Fed statement, Fed policy meeting later this week, you'll be a bit pointing out this. You could see a pretty strong rally in cryptocurrencies, unprofitable tech companies, banks, and emerging markets here. So for right now, it looks like the market is positioned defensively into Fed Day. We saw that in the markets yesterday, seeing a little bit of that carryover in today, but that could turn on a dime with one word, Jerome Powell.
Yeah, and that then speaks to what these fund managers see as the biggest tail risk right now. And it is indeed central banks and the policy that we could see. And as we've been hearing in recent days, Brian, the potential for a policy mistake, I think, is really top of mind for investors here. What would a policy mistake look like? Well, that depends on who you talk to. Will central banks be too late and too dovish to attack inflation? Will they be too aggressive and overdo it and choke up economic growth? It depends on who you ask. This particular survey finds that hawkish central bank rate hikes are a risk to the market here, whatever they mean to the underlying economy, that because we have seen so much liquidity in the market, once we see a rate start to go higher, that could put an end to, or at least mute the party that we've been seeing. But at the same time, number two here is inflation. So if inflation is a risk and the Fed has to raise rates in order to deal with inflation, then, it's sort of a lose-lose situation, I guess.
Asset bubbles, also a risk, number 4 on that list. But what is not a risk, and which is good, and I'm in a great mood today, so I'm going to stay on the positive side of this survey out of B of A. Recession remains a contrarian call. So good to see investors not positioning for some form of recession. A lot of folks I talked to on the street saying a recession is not probable until late in 2023, if at all, in large part because of those rate hikes, which will start to accumulate later next year and into 2023. So no recession risk. That's pretty cool.
Wait, who is this? You're not gonna, warn us
I'm in a
about
great
some
mood.
dire
I'm looking at
consequence?
the brighter side of the coin today. More in line with my historical
Oh, I like this.
Yep.
And then finally, here's another chart that stood out to us: the rate hike expectations. That are being priced in at this point in time. And as you can see, the expectations have really ratcheted up here. The purple line there is where they are now versus where they were just a month ago. And so now we are seeing consensus at 2 rate increases in 2022, although 1 is still up in the running, it's fallen back, and 3 has gone higher. So whatever way you slice it, it's definitely consensus at this point that we are going to get, let's call it 1 to 3, between 1 and 3 rate increases in 2022. So that is where these concerns are coming from, that are being reflected in that list of tail risks there, Saz.
Yeah, bullish CDs. Got to go to those my local savings and loan bank and start whipping up those CDs ahead of those interest rate hikes. Julie, very excited about that.
Well, I mean, that's kind of what those what the fund managers are doing too. If they're going into cash, right? That's effectively what they're doing. But again, as the Bank of America survey finds, or as their rule finds, if all these folks are in cash, maybe that is a contrarian signal. Well, if it is a contrarian signal, we're going to ask our next guest if that is the case. That is Mike Antonelli of Baird. He's going to join us in just a few moments. Again, this as we see futures down this morning, you know, technology, which has been so susceptible to concerns over rates, is taking the biggest hit. We'll be right back.
With 2021 almost over, investors are looking for new money-making positions as we head into the new year. Joining us now to discuss some potentially hot sectors is Michael Antonelli, Baird PWM market strategist. Michael, always nice to see you. We're going to get on your picks next year, but I have to start on these meme stocks because GameStop, AMC, they are getting lit up again here in the pre-market, under major pressure for the second straight session. My question to you, why aren't these names getting defended?
So I popped over to Wall Street Bet before we came on here just to kind of see what the mood was over there. And there's definitely a lot of gallows humor in the memes and in the posts. And then also I looked at the chart. It looks like GameStop will have a death cross today. It's going to have 50 is going to cross over the 200 to the downside before AMC's will. Two things on the meme stocks. Let's remember that we call them meme stocks, but in essence there's another name for them, and that's story stocks. And story stocks are usually, fast growers, high flyers that benefit from flows from cheap money. And at their apex, the apex of these names, the story was hot and there was a lot of money around, right? Stimulus checks, 0% interest rates, and all of that has been waning, which kind of brings me to another point, and that's the Fed, right? The Fed is the entity that takes the punch bowl away. So when the Fed brings that punch bowl out of the party, it kind of reduces the amount of money and cheap interest rates that are in the market. And these story stocks, meme stocks, have seen the apex of their interest. And just think about Dogecoin, right? It's a crypto that's basically a meme or a story. And same thing, right? The apex of that was Musk on Saturday Night Live. So they need the story to be active, and they need cheap money, and both of those are kind of being challenged.
So but you know, what's interesting about that is we're not seeing that everywhere, right? Like, or it's been so choppy and really a day by day, if not moment by moment situation when it comes to large cap tech, for example, when it comes to crypto, which yes, has been getting beaten up, but then you see these little pops here and there. So as an investor, like, how do you follow that? Or do you just kind of sit back and come back in 2022? I don't know.
Yeah, I mean, as you approach the end of the year, there's definitely a certain segment of investors, or whether they're high frequency traders or whether they're institutional, that say, all right, I'm up a lot this year. I'm just gonna cut bait and just move on for the rest of the year, come back in next year. And then there's the retail investors who are investing for the long run, the kind of ones I've talked to. And I like to remind them that when you're thinking about what you're in, are you either speculating or are you investing? And for the most retail people, the GameStops and the AMCs and the other kind of story names, those are speculations. They're doing it with a pocket set of money. But they're investments, which are, you know, a broad-based set of mutual funds and cash and real estate. Those are set for the long run. And those are comprised of the Apples and the Amazons and the Johnsons and kind of the big names. So speculation, investments, those are two different things. I think a lot of people are bailing on those speculations, and that's how I see the difference.
Right, you should only see my Twitter feed right now. I tweeted about GameStop and AMC this morning, and the response has been pretty ugly. But you know, listen, you've had people that have been left holding the bag. You look at GameStop down about 63% from its highs earlier in the year. A lot of folks are getting crushed despite their belief in the company. My question is here that, you know, with these declines, are you worried that this pushes the retail investor out of the market for some time? I mean, these investors have really helped power the market this year.
Yes, and we certainly will be watching that. You can see that in the data, right? You can see that in the flow data. You can see that in the options trading data. We'll be able to tell whether what you're saying is actually happening, not in real time, but in a fairly kind of robust way. And yeah, you know, I talk to retail investors all the time. Remember, that's kind of my main role right now, and I like to remind them that there's all sorts of environments in history in the stock market. You can be interested in one sector, and if that kind of burns you, there's all sorts of other sectors. You want to talk about ideas for next year? I got a sector for you guys. We'll get to that in a second. But yeah, I do worry a little bit that people will learn the wrong lessons from this, and the wrong lesson would be, I'm going to abandon stocks completely because I got hurt at GameStop, right? You know, we all can learn as children what it means to be burned in a book, but when you touch the flame, that's when you actually learn. And I think a lot of retail investors are going to learn that speculation is a dangerous thing, or speculation can go bad for you in a hurry. But I will be there, and I know you guys will be there, and then lots of people will be there to remind them that investing is something else, and we can't abandon that.
Either that, or they got in January and they're doing fine still. I don't know.
Yeah.
We'll see.
Maybe
they timed it right. Let's give them a little credit. Maybe they did fine.
Yeah.
Maybe they're going to move on and they'll still do fine. Maybe they're not leveraged. I don't know what they're doing. Let's get back to the Fed for a second, Mike, and get back to that fund manager survey that we were just talking about from Bank of America. Everybody getting into cash. They're worried about Fed hikes here. Do you think that cash positioning is indeed a contrarian signal here?
Yeah, I looked at the same kind of survey when I woke up this morning too, because it's always one of my favorite things to look at. Yeah, you know, those cash balances growing to me are people leaving those high flyers. You know, we look at the Zooms and the Pelotons and some of those other high flyers. I think those rising cash balances are people leaving those names, and now they just kind of don't know what to do with it as they come into year end. Maybe they're waiting for the start of next year to deploy that cash. So I think that's a good kind of supportive mechanism for the market. Brian mentioned REITs. Remember, REITs was on that survey. In times of high inflation, our friend Nick Majuli looked at this. In times of high inflation, say inflation running over 4%, the best performing asset class is actually REITs. REITs, and then it's international stocks, and then the S&P 500 are the top three. So when I saw that, I thought, you know, they're positioning themselves for high inflation. But those kind of things, you know, can be a little lagging, right? Inflation might turn over next year, and then they're kind of in the wrong sector as the Fed hikes. But that is the top sector for high inflation.
This might be the last time we see you before the new year. The floor is yours. Give us your top picks for next year.
All right, I want everybody to stop talking about tech stocks. I want everybody to stop talking about cyclical stocks. I've been on Yahoo Finance a lot. This is my home. I love this place. Home builders, the home sector. Housing has a decade-plus tailwind behind it, okay? There's so many names between this consumer discretionaries and renovations and home builders. Stop with the tech. Stop with all the interest rate stuff. listen, the entire home sector is very attractive. There's 80 million millennials, and they're all looking for homes, and interest rates are low. We don't have enough of them. Let's focus on that sector and find some good investments to start the year.
Okay, Mike, I hear you on this. However, but home builders have been having some trouble, right? Their costs have gone up like crazy. They've had trouble finding labor, right? We saw what Zillow had to go through to try and flip all those homes they bought. And if rates are still low, and rates are still going to be low even after they start going up. But I just wonder what that capacity and what the cost is going to look like and what the demand is going to look like.
So it doesn't have to be just home builders, right? There's renovation names, there's decking names, there's painting names, there's there's all sorts of consumer discretionary names that go into kind of that home trade, if you will. XHB, if you look at some of the ETFs for home builders, those have been doing well lately. You don't necessarily need to be in just home builders, like you're saying. Maybe that's a part of the value chain that's a little more challenged than the other ones. But I am just so bullish on homes. There's just not enough homes in the United States. If you look at research, there's less than 300,000 single-family homes for sale in the United States. That's not enough. I think this is a sector that has a lot of tailwind that's not kind of impacted by some of the other things we talk about, like high valuations or story stocks or meme stocks. To me, it's a sector that doesn't get talked about enough, given the kind of tailwinds that it has.
Well, you are indeed one of our favorites too. Michael Antonelli, Baird, PWM market strategist. We'll catch you on Twitter. Have a great rest of the week. All right, meme stock favorites, GameStop and ANC are getting pummeled into the ground again this morning, as we just talked about with Michael. We're back with some analysis here, and Beyond Meat shares are getting a look after a tough stretch for really a few weeks here. More on this one coming right up.
As we approach the opening bell on continuing their fly here from this Tuesday. And there they are. They're down about 2.5% here. The decline that we have seen in Tesla now since its record high, which was on November 4th, is about 21%. And that's before almost now 3% decline that we're seeing ahead of the open here this morning. So obviously in a bear market, and Elon Musk is selling more shares. His total now share sales amounting to about $12.7 billion worth of stock a week. So 5 weeks pretty much coincides with that top that we saw in the Tesla shares. The latest sale here, he sold almost 1 million shares for about $906.5 million. And again, a lot of this has to do with taxes on the exercise of options. So interesting here, Sag, that we continue to see this, and it seems to be tied to what's going on with these share sales. But, you know, it's not the only concern that we are seeing with these Tesla shares.
Yeah, it's not just the share sales, Julie, of course, but that is anytime you get an Elon Musk dumping his stake in the company he helped really build from the ground floor, that is going to be headline risk to a high flyer like Tesla, but also, too, let's keep in mind, we have seen really a major sell-off in these high-flying tech stocks over the past month and a half. They're off their highs of the year, large part because of that tone or that shift in tone from the Federal Reserve. It has been cheap money from the Federal Reserve. I continue to argue that has helped fuel this rise in very risky high beta stocks like a Tesla and like many others here. So once that is starting to look like it's going to unwind, as it is likely to next year with a series of rate hikes potentially from the Federal Reserve, you're going to see investors, as they have in the past few weeks, take profits on these names, and Tesla's one of them.
Yeah, and at the same time, we're also hearing from Elon Musk that they are going to be, Tesla that is going to be accepting Doge for some merchandise. It's not clear what exactly that is. It doesn't sound like it's Tesla vehicles, but it's all the other stuff that they sell on the site, including the cyber whistle, perhaps, although that's sold out right now. And Doge, on these comments, up about 19%. He seems to be saying that Doge is a better mode of transactions than something like Bitcoin, for example.
Hey, only thing I'm buying off Tesla's side is maybe a Tesla branded hair clipper. I love that Elon Musk haircut. Big fan. Big fan. I'm a buyer.
Can't believe you're still talking about the haircut. It's growing in on the sides a little bit. I saw.
Great. I wish I could do it. I don't have the hair. I'm just being honest. I don't have the hair for it. I wish I could do it.
Well, I'm glad that his haircut has one fan. So what, you know, it's not only to me about Tesla, right? Tesla is sort of emblematic of what we were just talking about with Mark Antonelli, which is the money coming out of the market, this sort of thirsty cash that we've been talking about this year, that has been looking for that sort of quick burst. It got it in Tesla, and of course Tesla's still up on the year, we should say, even though it is down so abruptly from early November. It's still up on the year, so people are still up. But you know, as we get closer to those rate increases, I imagine you're going to see more profit taking like this, or maybe just as we get closer to the end of the year, right? And you see some of this tax-related selling.
Yeah, really. The only thing that'll probably stop the selling is another earnings report out of Tesla. Of course, that's coming in a few weeks. Earnings season just refuses to go away. It's just popping up quicker and quicker every time it pops around. It is a true storm. But again, I think another solid quarter from Tesla will go a long way just to reestablishing that bull case in the stock.
Well, and the next earnings report will be in 2022. So presumably by then, you know,
he's down to the 20%, right?
Tax situation. You know, he'll stop. Well, he'll be done with the stock sales, right? Because he'll have done all the stuff he needed to do for tax purposes before the new year. Maybe we'll see. All right, we'll see also what the trading day is going to look like. Right now, not good. If you look at the Nasdaq, it's just indicating a drop of 1.25% at the open here. It's definitely risk off. We didn't talk as much about reducing prices, but that number came in this morning hot. And the GDP begins today. We're going to hear from the Fed tomorrow. And there's VMware ringing the opening bell here this morning as we get underway and as we see this decline, particularly for technology stocks that we have been watching here. As I was just mentioning, again, we've got the two-day Fed meeting beginning today. We're going to hear from the Fed tomorrow. And the broad expectations, the Fed is going to announce that its bond buying program will end sometime perhaps in the spring. March, April is what a lot of folks are talking about. And then we will start to get rate increases. So that is the broad expectation. Any deviation from that expectation will likely cause some kind of reaction in markets, and even a confirmation potentially of those expectations will cause reaction in markets. Right now, we're seeing the opening bell pretty much in line with where we saw futures. The Nasdaq falling about 1 1/3% at the open here. The S&P off 0.75%, and the Dow is off by about 0.25%. So we're going to keep watching those opening prices and see what groups and individual stocks are on the move the most. But one of the other stocks that we're watching this morning is Luminar. Luminar, of course, the LiDAR company, the company that's developing technology that uses lasers in order to help autonomous cars navigate themselves. A couple of things going on here this morning. First of all, the company is instituting a buyback of at least $250 million in stock, and Cowen initiating coverage of the company with an outperform, saying, quote, Luminar has separated itself from the crowded automotive LiDAR space with significant validated wins, and by making the leap from component supplier to solutions platforms through software. So it's interesting that the company is doing a buyback as well at this stage, Saz.
Yeah, it's not something you normally see from an early stage company, but it does make sense. You do see Luminar shares down about 53% year to date, despite this company, and we've talked to founder and CEO Austin Russell a ton this year, despite this company continuing to rack up advances in its technology, continuing to rack up really a lot of large contract wins, and continue to show that it's going to be a major player in the autonomous field, and that has a pipeline of business that it will start to generate revenue from very soon, within the next 18 months to 24 months, if not even sooner here. So I can't say I'm surprised to see something like this, but again, I would say this is a bullish indicator that the company is putting its money where its mouth is, notably founder Austin Russell out there buying more of his stuff.
I'm a little surprised. I'll admit to being a little surprised that they're doing this. And by the way, that Cowen initiation, they're setting the price target at $22. That would mean another 50% or so upside from yesterday's close. So interesting here. We are seeing Luminar shares rise this morning on that. And then also moving on and talking about the continued unraveling of the conglomerate as an idea, as a structure. We saw it with GE, of course, and 3M is now, at long last, it's been trying to do this for a while, separating its food safety business and combining it with a company called Neogen. The combined company going to be valued at about $9.3 billion. So we're not seeing much reaction in the stock here. 3M has been talking about this and exploring this since at least last September. So maybe that's why we're not seeing much movement in the shares, although Neogen had actually been moving more in pre-market trading stuff.
Yeah, I'm a little surprised on this one. Actually, Julie, we're not seeing more of a market reaction here. This new company being valued at $9.3 billion once it is in fact spun off. But we talked about it when GE came out a couple weeks ago and said it would split up its company. That was really, I think, just putting a flag in the ground and a notice to other conglomerates that investors are demanding more returns in that model where you dump everything under one roof and you think you can do everything like you did 20, 30 years ago. That's no longer going to work. In this market, companies that could spin off assets are being awarded higher valuations. Looks like 3M got that memo, hence they're moving forward with this deal.
Yes, indeed they are. So we'll keep watching those stocks. Maybe we'll see some kind of extension of gains, particularly for Neogen. And then finally, we got to check on AMC and GME again. This has been your cause of the morning, I guess it's safe to say, Brian Stassi,
Yeah.
Although I don't think you're regretting that decision yet on Twitter here. But AMC and GameStop have been falling. They've been falling recently, as I mentioned. In the open, they're each down by more than 40% from their most recent highs, and they continue to fall this morning, AMC in particular. Now, AMC, I'm Aaron, the CEO, recently announcing an insider stock sale, although that was something that was telegraphed. But nonetheless, we're definitely seeing some money come out of here. I have to think that some of this is sort of end-of-year profit-taking in some of these companies, like a Tesla as well. I don't know, Saz. I think you have sort of a darker view of what is going on here and the effect it will have.
Yeah, I put a simple question out there on Twitter this morning, Julie, which I'm getting some very interesting responses to. Who bullish? I want to know who bullish out there. If you are still bullish, AMC and GameStop, hit me up on Twitter because I'm very curious, because you're probably sitting on a ton of losses right now. Both these stocks are down more than 6% from their highs this year. And it really is simple to explain. You have AMC Chief Ape Officer Adam Aaron dumping millions of dollars worth of shares. Now with the company's CFO is dumping stock. You have GameStop last week off of their earnings call, 8 minutes and 14-second earnings call. Absolutely embarrassing. Where's Ryan Cohen's turnaround plan? So again, there have been two catalysts here in the near term for these sell-offs. My question here is, who bullish? Cynthia.
Well, I think lots of people are probably still bullish on this stuff. The people who were
Well, they're
bullish
losing
on
money.
this stuff and were
They're
sort of
losing
true
money.
believers before, no, they're not necessarily losing money. Why do you keep saying that they're losing money? It depends on when they got in. It depends on when they got in. If they got in early enough, they're not losing money.
I would suspect, Julie, a lot of these folks got in at the top. They got sucked in.
Maybe, but we don't, I don't know. We just don't have any confirmation of that. Yeah, certainly some people are losing money, but to make a blanket statement, I just don't think we can say everybody's losing money on these things. And as you well know, Brian Sozzi, and this is, I don't know, maybe cliche to say, you don't lose any money until you sell your stocks. Maybe these people are holding fast, and so they're not losing until they actually get out. And if they are bullish, maybe it'll help. We'll see. Okay.
I will report my findings.
Yeah.
I will report my findings.
We are report your findings, please. I'm sure you're getting lots of feedback on Twitter. All right, we're going to put a pin in that for now. And coming up next, we're going to check in with our Jared Blickery on the floor of the New York Stock Exchange. Ooh, we'll be right back.
Welcome back. Let's head down to the New York Stock Exchange and check in with Yahoo Finance's Jared Blickery. Jared.
Yeah, well, we're down a little bit today, but I got to tell you, with that big Fed meeting tomorrow, I got to think, if I'm a PM, if I'm a portfolio manager, I'm underperforming the S&P 500. I am praying for a low, a tradable low that I can ride into the end of the year, maybe with a little leverage and get a few hundred basis points of return tacked on to what is actually a lackluster year. And I think there's going to be a lot of that. So I think there's going to be a tradable low around the Fed. Powell is not going to stir the boat. He's not going to rock the boat. probably the biggest headwind to the market here is Omicron. If there's some kind of a new variant or something to be done with Omicron that people had not expected, not priced in, I do think that is pretty much the only headwind we're facing at this point. Now let's take a look at some heat maps here. We are seeing the mega caps largely under pressure here. We did see tech take a backseat yesterday, but Apple, most important stock in the solar system, is up 0.9%. I think portfolio managers, traders, investors can be wanting to take a look at some of the stocks that have been performing very well this year. I'm not going to go so far as to say this is a cash stock, but in investors' minds, kind of is. And you talk about that cash on the sidelines. Great report this morning from Bank of America. Great write-up from you, Brian Sazi. I think a lot of that cash is going to be deployed into the end of the year. We'll have to see if that happens. But that's my base case right now, and the market can prove me wrong. I am seeing some defensive plays in the sector action over the last few days, but financials outperforming today. So if we can get that value and cyclical trade back on and see some more green on this leaders and sentiment screen, I think that's going to be conducive to an end of the year rally here.
Yeah, thanks, Jared. It feels like I almost forgot I wrote that story this morning. It happened so long ago. But talk to me on the memes.
Sure.
I'm sure,
Yeah.
right? I'm getting raked over the calls on these meme stocks on Twitter. But look, I mean, they're selling off. Where are the buyers? They're just not stepping up.
Yeah, I'm not seeing buyers today. I haven't seen buyers over the last month. You take a look at this heat map. This is what's happened today. I'm going to change this to a 1 month view. There's a lot of dark red there. And when we sort by performance, you can see there's almost no green, not a lot of big names at the top there. Nokia stands up. Big deal. Look at the bottom here. The biggest underperformer over the last month is Robinhood. That is arguably not a meme stock itself, but it's kind of the center of the action. And I think it's telling that is a sentiment indicator for a lot of these meme stocks. Robinhood is down 45% from its IPO, much more from its initial high there around its IPO. And you take a look at this space. Hot money has not been flowing into it. I'm going to get a chart of GameStop here. And to your point, Brian, and to your point, Julie, yeah, it depends on where you got in. So if you got in GameStop on January 1st or December 31st, you're sitting on 600% gains. That's really nice. However, I look at the average position of an investor, and for that I go to anchored VWAP. And I don't have the precise lines on here, but I can tell you what that looked like. So if an investor got in here, they're probably underwater right now. That line looks something like that. So if you're below that line, the average investor is underwater. And if you're above, then the average investor is in the green. And that has a lot of potential to dictate market action. So on a very short-term time frame, let's go down to a 1 month view. If I'm in GameStop right now and I'm looking to exit or I'm looking to buy, I'm going to wait until the average investor over a certain time period is in the money. But just to take an arbitrary date like the beginning of the year, beginning of the quarter, that has uses, but I think we've got to look at multiple time frames and multiple angles here.
I like all that analysis, Jared, because it agrees with my views. Jared Blickery. Check you later. It's time for the Yahoo Finance stat of the day, folks. The bulls are running wild on Wall Street, at least among those that fancy themselves as strategists. According to FactSet data, the aggregate S&P 500 12-month price target on Wall Street is 5,225. That's about 12% higher from current levels, despite the threat of higher interest rates next year. All right, coming up, CEO Dylan Lissette makes his return to the Yahoo Finance airwaves. Always lots to talk about with Dylan. Notably, if he's eyeing any more big deals, the company has gobbled up about 15 snack brands since 2011. So pull out those chocolate dip pretzels. We'll be right back.
Tobacco giant Utz Brands releasing its latest retail sales numbers during an investor presentation this week. The company has been seeing higher demand. Sales have been outpacing the broader salty snack category on a 2-year basis. And Utz has also, of course, been making a lot of acquisitions, including a deal with tortilla chip brand R.W. Garcia. They closed just this week. Joining us now, Utz Brands CEO Dylan Lissette. Dylan, it's great to see you as always. We've talked to you a lot about that acquisition strategy and the growth that your company's been seeing. I got to start, though, with what the stock has been doing, because it doesn't seem like investors are getting the message here. You guys have underperformed this year. We have seen a little bit of a bounce off the lows, but what do you think investors have been missing about us?
Well, it's, we came out of being a public company and we were SPAC, and we kind of had this, very far run up to a very high price point. Underlying whatever was happening with the stock price, we were running the business to the best of our ability in a very challenging environment. What we do know is that we continue to see incredible demand for the products. The sales, as you noted, and we just recently shared updated results of retail consumption. The sales, have outpaced in general our ability even to supply the demand in a challenging environment. So we continue to see this increased demand for our products. We're meeting that demand. We're starting to see that grow. Retail consumption is up. The stock price, like you noted, has been ticking up more recently. And, as we look forward into 2022, we're just in a really good spot to continue to grow geographically into the Southeast, into the Midwest, into the West. And as you know, our M&A strategy has been very robust, and we're adding a lot of capabilities and brands and capacity to our network. So as we just look forward into 2022, I think we're going to have a fantastic year.
Dylan, it seems like every day this month we've heard of large companies pushing back their return to office plans. I mean, are you seeing anything in your data that consumers are, starting to restock their pantries, not to the extent they were in 2020, but again, start to restock their pantries as they're going to likely have to work from home longer than they would have liked to?
Well, it's really funny, Brian. I mean, we've seen demand really incredible all through the summer. I mean, I don't think there's any recent uptick due to Omicron or any of the variants that have come along. The demand has just been really robust. This is for us, but for the entire snack industry as well. So maybe that's part of the return to working from home, and some people have moved back into slowing down their return to the office and working from home. But really, the demand has been there all through the summer, into the holiday season, and as far as we can tell from our conversations with our retail partners, it's going to continue into 2022. So I'm not sure if it's really a migration of folks no longer being in the office and going home or not. But it's just a really robust environment for all of snacking, to be honest.
And Dylan, we always like to hear from you kind of what's hot at the moment. Where are you seeing particular demand, both in which kind of categories or individual products, and also geographically?
Yeah, geographically for us, I mean, the Southeast, the southern states, Georgia, Alabama, Mississippi, Florida, Texas are very strong for us. The Midwest is very strong for us. But in our core, we're seeing really nice results. In terms of products, the pretzel subcategory has been hot. Variety packs, which is kind of interesting. I'm not sure if that's sort of related to COVID sort of eating habits changing, but variety packs, small bags, and a multi-pack have been incredibly hot from a demand perspective, and that's a really tough one for most manufacturers to deliver, because it takes a little extra added component of labor and effort to put that variety pack together. So those are really some of the areas that we've seen a lot of increased demand in.
Dylan, maybe you can help me explain this one. You license out TGI Fridays, and those products for you have been a strong seller. There you can see it on the board. Why? Do you have other opportunities where you can link up on the licensing front?
Yeah, it's an interesting area. When we acquired Inventure Foods in 2017, one of the brand components of that company was the licensed TGIF. It's really interesting because we're able to take something that has a known brand name. We're able to add the components of snacking foods, behind it and utilize our distribution system. If you think about it, On the Border is also a licensed brand as well, and that's grown to well into the 200 million plus retail sales arena. So there's a lot of opportunity in license that that may be in the future for us to consider. But we also like primarily owning our own brands and investing behind those brands primarily first. But a lot of opportunity on both sides.
Yeah, and anything, of course, Dylan, we learned from today's producer price index, inflation remains a big problem for a lot of companies out there. Have you had to take any price increases, and are you done yet taking any increases if you have taken them?
Yeah, so we've taken pricing, Brian, all throughout 2021. In early 2021, we kind of assumed and were able to look forward into the year and understand that with what we thought was going to be, sort of mid-single-digit inflation, I think we called it out around 4%. And it really ended up being at least double that as the year unfolded. So we were taking pricing throughout the year. We just recently took some more pricing. We have a little bit more that we're taking in February of 2022 as well, just as a way to try to stay ahead of all of these cost inputs. There's a lot of cost inputs that go into fuels, edible oils, things that we fry in, components and packaging, labor, et cetera. So we have a lot that we've taken. We have the rollover effect that'll benefit 2022 more so than 2021, and we've got more coming. So that and a significant focus on productivity and the things that we can use to drive and take cost out and increase our efficiency are big parts of our 2022 plan as we go forward.
All right, thanks so much, Dylan. Good to see you. Dylan said, us brand CEO, good to catch up with you and happy holidays. All right, let's take a quick break. Before we do, shares of Peloton are down right now. We're seeing a drop of about 3.5%. And that's after a report on the Asian site Digitime that the company has halted its new product development for 2022. We're continuing to follow this and try and get more details, and we'll bring them to you when we have them. We'll be right back. Well, we found out two things here this morning that Brian Sozzi was very excited about. One, pest control company Terminix is a public company. Two, it just agreed to be acquired. And oddly, this made Brian Sozzi's morning. Soz, take it away.
Yeah, you don't need to know anything else about me, Andy, because really that's all there is. But look, two aggressive sounding names here: Terminix, Rent-O-Kill. So these bold companies are both going to combine, and they have really a long storied history. You have Terminix, who I've grown up seeing these commercials on TV. They were founded in 1927, and then Rent-O-Kill, I think I'm saying his name right. They were founded in 1925 to attack death watch beetles, and of course Terminix was founded to fight termites. So this deal, $6.7 billion transaction. These companies will join forces and try to dominate the world and rid the world of pesky rodents and nasty, gross bugs that infiltrate your home and make your life absolutely miserable. I am surprised, though, to see, just from a Terminix perspective here, just given the boom in housing we have seen over the past year and a half, 2 years, that this Terminix business is not growing more, more strongly. It's essentially growing at a low single-digit percentage in terms of sales, low single-digit percentage growth rate in terms of adjusted operating margins. The stock's been under pressure, I believe, about down 26% before this transaction here. So from a Terminix perspective, looks like you're getting on top. These two companies, if the deal closes, which is very likely here, will control about 30% of a highly fragmented U.S. market. Terminix noting in its 10K or annual report, there are more than 20,000 companies in the U.S. Doing various rodent elimination services, so a highly fragmented market, but all in all, makes sense. Now they can gear up and try to rid the world of really just bed bugs, and of course they focus on bed bugs too. Interesting companies.
That little bug looks worried. Who's next to you on the graphic?
I'm worried about that image. I'm worried about the image. I will add this too. Perhaps why these stocks have fallen out of favor. These are not exactly ESG-friendly companies. Let's be real. These folks are showing up in suits to your house, spraying your lawn with very powerful chemicals. So in this new age of ESG investing, both of these stocks are probably not in that portfolio.
Maybe. I mean, also, as you mentioned, it is highly fragmented. So maybe it's just a matter of that there's a lot of competition in this industry, right? That there are a lot of mom and pop pest control companies out there. Maybe that is part of it. Who knows? All right, we're going to leave that there for now, you and the little fly. But we've got much more ahead in the next hour, including an interview with the Exxon Motors president and vice chairman, talking about the latest numbers on electric vehicle sales coming out of China and much more. And we'll also talk to the Allbirds co-founder and co-CEO about what is going on for that company. They've got a new collaboration with Adidas. Quite interesting. We'll be right back.
Tuesday morning. I'm Brian Sozzi alongside the one and only Julie Hyman. Got a quick peek at the markets as traders digest news out of China reporting its first Omicron case and await a policy decision out of the Federal Reserve later this week. You're seeing some mixed action across the board. Dow in the green, NASDAQ in the red, S&P 500 also in the red. Now, here are a few other things we're watching for you at this moment in time. The meme stock volatility continues. Shares of AMC and GameStop are in focus again today after double-digit percentage sell-offs on Monday. Both those stocks are in the green, but we're down big time in the pre-market. Lots of volatility in GameStop and AMC right now. And the deal news persists this week. Today, bug squasher Terminex says it will sell itself to Rentokil for $6.7 billion. And 3M is spinning out its food safety business, valuing that segment at $9.3 billion. And the power the power hour, I should say, is in full effect here on the morning show. We're live shortly with Exponent Vice Chairman Brian Gu, who is visiting the New York Stock Exchange today, and Allbirds co-founder Joey Zwillinger stops on by to chat about a new collaboration with Adidas. But before all this fun, let's get over to Inez Ferre for some more fun and a dive into the markets. Inez.
Look at the sectors right now. We are watching technology stocks that are under pressure. Then we're also looking at real estate, communication services that are lagging. Looking at the NASDAQ 100, we are watching the mega cap names. Now Apple turning red. We're also watching Google, Microsoft down more than 2%. Amazon also lower, and Tesla down 2% as well. I do want to mention the software stocks because we are seeing some selling there. Adobe down more than 6%. This is after JP Morgan downgraded Adobe and some other software stocks as well. Then looking at the Bitcoin space, we are seeing Bitcoin down more than 2% above the $47,000 level. And also, of course, we've been watching Dogecoin just absolutely surging up 18% after Elon Musk said that Tesla will accept the coin for some merchandise. And then looking at the travel sector, which yesterday was in the red, today seeing a little bit of a rebound for these airlines and cruise lines as well. Brian?
All right, thank you so much, Inez. All right, the market is also monitoring the latest on President Biden's $1.7 trillion economic plan. Swing voter Joe Manchin continues to voice concern with the plan after a call with the president. Yahoo Finance senior columnist Rick Newman is here with a hot take. Rick, give us the hot take.
So Manchin's still playing footsie with everybody in Washington, saying he's not on board yet, but he's engaged and he's having productive conversations with President Biden. I've got to guess at this point that Manchin has decided he's going to support this legislation in some form, and probably or perhaps do it on Biden's timeline, which is by the end of the year. So I mean, just ask yourself this question: would Manchin, who is a fellow Democrat and an old pal of Biden's from the Senate, would he be really be stringing Biden along and saying, okay, let's have these conversations if he intended not to vote for this thing and sink the whole bill? I don't think so. So I think the fact that he and Biden are having these conversations is actually bullish for the bill. Of course, it has shrunk in size a lot because of Manchin's objections to the larger price tag of earlier legislation. But now you've called it a 1.7 trillion. Let's say it's in the ballpark of $2 trillion. I'm kind of guessing maybe the Democrats will be able to pass this by the end of the year.
And so if it does get passed, Rick, I mean, we don't know what's going to be in there, right? But what do you have the highest degree of confidence will stay in the bill, and what will be the effect?
We do know what's in there. People have lost track of what's going on with this bill because it's been going on all year. Programs are in, programs are out. We do know what's in general in there. The question is really the time frame. So in order to get the cost down, they have not taken wholesale elements of the bill out. What they've done is they've just shrunk the time frame these will be in effect, which is one of Manchin's objections. So, for example, continuing the child tax credit, Democrats want to do that indefinitely, but this bill would only do it for 1 year. So what happens at the end of 2022? We don't know. I mean, could Congress extend it again? Yes. The idea is once these benefits come into place that they just kind of stay in there forever. It's hard to go in entitlement, but that is part of the problem. I mean, the public just really does not have a clear idea what's in this bill. And that is one of the reasons that there's just not a ton of really heavy support for getting it done.
All right, Rick Newman, with that hot take. Rick, always good to start our day with you. We'll talk to you later. All right, coming up, Allbirds co-founder Joey Zwillinger joins us to chat about what the brand is up to this holiday season and what's on tap for next year. Stick around. Not often you see two sneaker companies join forces to collaborate on a product, but Allbirds and Adidas are trying to change that in the pursuit of making sustainable sneakers. After 12 months of teamwork and hard work, the pair is dropping the Futurecraft Footprint sneaker. It's being built as a performance sneaker with as low a carbon footprint as possible. Joining us now for more on this is Allbirds co-founder and co-CEO Joey Zwillinger. Joey, good to see you again. Thanks for taking some time this morning. Look, it's not often you see a company like yours team up with, I would say, a rival to come out with a product like this. But is this sending a message to other companies in apparel that in order to drive the change in how products are made, you're going to have to join forces together and do things in unison?
Brian, that's exactly right. I think you put it really well there. It's about still fiercely competing for market share and stealing the attention of consumers, but collaborating when it comes to sustainability. I think it's acknowledging that the problem we're facing is just it's vastly bigger than any single company can combat. And so coming together is a great opportunity to do this. We found it to be a controversial way to join forces with a competitor, and so far so good. The first work product that you're going to see drop tomorrow is pretty incredible.
Now, what did Allbirds bring to the table here? I'm from an outsider perspective looking into what you do. I imagine Adidas tapped Allbirds really on what you're doing in making sustainable footwear and apparel.
Yeah, look, there's a lot from both brands in this shoe and in the future products that we're going to come out with next year too, with the broader commercial launch. But what you see there on the side of the shoe, at 2.94, that's the kilograms of carbon dioxide emissions that is created in the production of that product, production and sale of that product. That's about half of the emissions of a Big Mac. The industry average is around 13 kilograms of emissions. So this is an incredible breakthrough, and that's a lot of the innovation that Allbirds brings to the table. So we have built the company on a foundation of research and development around incredible materials that allow you to be comfortable, perform if you're running in this case, and do that all on the backs of nature. So that we're taking the evolutions of naturally derived materials to create this amazing performance. And so we're able to bring that together, and we blend and fuse the design language from both companies, and we're really happy with the product.
Hi, Joey, it's Julie here. I was wondering about that 2.94. I'm glad you told us what was up there. So now do you apply that to all of your other new shoes? Are you going to be able to also get that number down for everything?
Yeah, we've actually been doing this since we started the company. So back in 2015, we started innovating around merino wool. We added something called sweet foam on the bottom of the shoe, which is the foam, which actually is used in this product as well, but with Adidas and the collaboration, where we take the waste stream of sugarcane and we transform that using biotechnology and a number of green chemical steps, and we put it into a foam that's incredibly comfortable underfoot. And so every time you step into a pair of Allbirds, the reason why they're so comfortable and they work so well is because of that R&D. So we've been doing that time and time again. This is a really nice evolution that we've taken as a step forward, and we're going to continue to use some of the learnings that we gained jointly with Adidas on this, but also a lot of the work that we're doing independently. And so much exciting things coming out of our company in the coming 12 months. We've got a performance side and our lifestyle side, and that's true now for footwear in particular, but also with apparel. As we go up the body, we're bringing some of these natural material innovation to bear on incredible second skin comfort. So this is the most exciting kind of 12, 24 months of product pipeline that we put out, and it's all for that reason, Julie, for that material innovation.
Yeah, no, I'm definitely familiar with your guys, sort of the way you operate, the way you've done on other shoes. I just wasn't sure numbers-wise if it was quite as low as it is for this shoe. I'm also curious, obviously the shoe's got to get to people, right? And they frequently have some carbon output by shipping them around the globe. How do you guys think about that challenge, which is, it's obviously not a challenge, just a challenge for you, it's a challenge for anyone making and shipping goods?
Yeah, it is. The effect of globalization has been that there's a lot of shipping cross ocean, and when we do that, we focus on doing ocean transportation. It's still by far the lowest carbon intensity method of moving products around the world, and it's not just the finished good going from our factory to the warehouses. What we're trying to be mindful of is the entire global supply chain. So when you think about what we do, it starts at the farm level. We work with sheep in the case of merino wool. We have eucalyptus fibers that we take, and we have to move each of these components and assemble them in a thoughtful supply chain. Being mindful of the overall carbon footprint is what we're optimizing and trying to get to zero. Now, of course, this starts with the consumer. We start with a problem that we're solving in terms of great comfort, great style, and great performance. And then we utilize nature to drive that down to zero. So that's the purposes. And it's not just in the production. I'll just remind you, it's about getting it to the stores, getting it to the homes of consumer, in the case of our digital sales, and it's even the end of life of that product. So everything is contemplated and put into that one number. We liken it to calories on the back of a food label, where you're thinking about, I don't exactly know what a calorie is, but I know that if I want to burn it off, the higher the number, the more workouts I'm going to need to do. And same thing with carbon footprint. That's the way that we can be mindful of our impact on the planet while we're also consuming the product that we love.
Well, I do know, Joey, I'm not one to be eating Big Macs, like you mentioned ago, a lot of calories in those things. I was spending a few hours trolling your latest investor deck, and a couple things stood out to me. One, you're working on a plant-based leather alternative to hit the market next year. What is that going to look like?
Well, I don't want to reveal anything too crazy here, but we are working really hard. We invested in a company called Natural Fiber Welding. It's out of Peoria, Illinois, actually, and they're using natural oils, things like plant oils and the like, to create an alternative to bovine or cow-based leather. We've always wanted to have sneakers with leather, but we never wanted to utilize that component from live animals. And so what we've done is we've invested in this company and helped to co-commercialize and co-develop an alternative to bovine leather that performs exactly the same, is incredibly scalable, and will give us just such a compelling weapon in our arsenal to make products that are great. You can think of, if you look at the sneaker market, there's a ton of leather that goes around, probably next to the foam material on the bottom of sneakers, the most ubiquitous component in the entire industry. And so we've done it in a way where it's not only competing on performance, but it's a 98% reduction in carbon. And this is where the win-win of our company kind of is such a great, typifies what we try to do, which is drive the carbon down and at the same time create this wonderful customer experience as a result of that. So you should expect to see something really exciting in the coming months from that.
All right, sign me up for a pair of those plant-based shoes. And then secondarily, another thing I noticed, you want to broaden your footwear assortment. Now, you know you recently introduced trail shoes, but when you say broaden the assortment, what does that mean? Does that mean Allbirds is going to get into boots, let's say?
I think where we thrive and where we win is in the area of kind of that crossover phase of athletic performance and a functional lifestyle gear. So you might not see us going down to the catwalk and probably not into the rodeo for cowboy boots, but we are really focused on this that crossover and that intersection. And so I think when you mentioned the trail shoe, it's a really great example. We opened up and launched our first ever performance product. It's called the Dasher, kind of a basic running shoe. Do your 5-10Ks with a light workouts, Orange Theory, whatever you like to do. And then what we did was last year, or just recently, we introduced the trail shoe. That's a very specific use occasion when you're either hiking or running in the woods, whatnot. Amazing traction. We utilize brand new technology in that product, and it celebrates a whole bunch of different materials that we've done research on over the years. And we see next year the opportunity to really bring something compelling in the long distance street running. So this has to be lighter weight, utilize new technology to get incredible rebound. And this is what runners want. So it's just a slow, methodical march in the performance category of building credibility, using different use occasions and applying different materials to make this to be the best experience we possibly can be for runners. So this is just a methodical march down that line, and same mentality in the lifestyle space. So that's the kind of roadmap on how we develop this for the consumer.
Jack, finally, I want to ask you about your stock. You guys are trading below your debut price at this point. And, you know, you're saying all the right things, right? You're talking about growth. You're talking about your ESG sort of themes, which definitely hits the zeitgeist right now. And I don't know if it's because of more broadly what we're seeing in the market and sort of a more risk-off tone right now, but how much does that concern you? I mean, that's your capital right there, right? That is now, and your currency effectively that is now going down. So what message would you have to investors about that?
Well, I think the investors that we joined up with at the IPO and prior to the IPO, we had a number of really wonderful institutions that were kind of crossover public and private when we were a private company. And our message has always been consistent. This isn't a quarter-to-quarter game. We're creating a global brand that we expect to be resonant with, hopefully many, many millions of people around the world. And as we do that, and as we methodically grow that, it's a long journey. Fortunately, we're very well capitalized. We're not an acquisitive company, so we don't really think about our stock as currency in that respect. And for us, it's about hitting the numbers, building a phenomenal business financially, being true to our consumer and creating wonderful consumer experiences. And we think the quarters will follow. And I would say, I really strongly believe that the stock market is a wonderful weighing function for the health of a company in the long run. But today, if it goes up 10%, I don't feel 10% smarter, and our company's not 10% better. And if it goes down, same thing. So I really have fortunately been surprised at how successfully I've done not looking at our stock price because really it is the long term. And check back with me in a year and 2 years, and I think we'll be really happy with the results.
Point well taken. We'll leave it there. Allbirds co-founder and co-CEO Joey Zwillinger. Good to see you again. Good luck the rest of this holiday season. All right, a heavy week for deal stretches on with MGM and Vox Media getting in on the headline action. Julie is back with more on all this straight ahead.
MGM Resorts International is selling the iconic Mirage Hotel and Casino on the Las Vegas Strip to Hard Rock International for almost $1.1 billion in cash. The transaction expected to close in the second half of 2022. And MGM says the sale could provide $815 million in net cash proceeds. The move comes as MGM has been restructuring its portfolio over the past few years. Resort giant has owned the Mirage for 21 years and said it no longer wants to invest anymore into the property. Hard Rock's going to have the Mirage name and brand royalty free for up to 3 years. It plans to keep on the Mirage's 3,500 employees on its team. I did hear something about a guitar-shaped hotel as well. We'll see what comes of that. Vox Media is set to acquire Group 9 Media, as first reported by the Wall Street Journal. Vox will reportedly gain 75% control of the new entity, and CEO Jim Bankoff is in line to run the new company, while Group 9 CEO Ben Lair would be a member of the new board. Vox Media, owner of websites like The Verge, Vox.com, and SB Nation, has been expanding over the past few months. Group 9's brands include news outlet lifestyle site Thrillist, and animal website The Dodo. The combined company reportedly expected to generate more than $700 million in revenue in 2022 and over $100 million in profit. And Centene's chief executive Michael Neidorff is stepping down next year after leading the company since 1996. We've spoken with Neidorff many times about the company that he has led and built. The 79-year-old CEO is going to serve as executive chairman through the remainder of 2022. It's according to a press release sent out by the company, and they have begun a search for his successor. Additionally, Orlando Ayala and Richard Gephardt are going to retire from the board of directors before or during the company's 2023 annual meeting. As part of the agreement, 5 new directors will join the board. All of this coming as Centene has settled on a deal with activist investment firm Fullerton Capital Management. All right, we are going to take a quick break, and when we come back, we will be talking electric vehicles with Xpeng Motors Vice Chairman and President Brian Goode. Stay with us. for watching the meme stocks this morning. GameStop and AMC, we have been seeing quite a wild ride for those shares. They are both off more than 40% from their most recent highs. Although I think that they're bouncing back a little bit here. Yes, here they are. They're bouncing back a little bit here this morning, actually, after being down just when we checked on them earlier. So a little bit of a whipsaw effect here. Let's bring in Clay Gardner. He is co-founder and co-CEO of the investing platform Titan. And I bring up the meme stocks with you, Clay. Thank you for being here, because they're sort of emblematic in a way of what we've been seeing writ large in the market as of late, which is this newer risk aversion, money coming out of some of what we called earlier in the year, the sort of places for thirsty cash to land, right? Is that something that you're seeing, and what do you make of that behavior?
Yeah, well, first off, thank you for having me. And I think it's spot on. I think the combination of pretty unprecedented, fiscal and monetary stimulus, since the depths of COVID, all that cash is going to go somewhere. And I think, the Omicron variant, a lot of folks are still, rightfully staying at home and waiting and seeing. And so again, that cash has to go get deployed somewhere, and we're seeing a lot of it get deployed, into many platforms that I view sort of like casino-like gambling. A lot of the day trading platforms and the meme stocks have been big beneficiaries of those capital flows. We put out a piece back when the AMC GameStop craze first kicked off, around how this could potentially, work out to these companies' benefit, even past this period of hysteria, which I think is interesting. And it's, if these meme stocks go out and they raise capital, these companies go and issue stock at elevated prices and raise capital, and then actually use that capital to invest. Could GameStop, for example, become the Amazon of games? I know that sounds far-fetched, but those are the sorts of things that we think are worth thinking through as investors, as opposed to immediately writing off the meme craze. I think the jury's still out. So, we and our clients are sitting on the sidelines at Titan. We don't own any positions in meme coins or meme stocks. We're quiet observers, but I am fascinated by, how these companies are gonna take advantage, or maybe not take advantage of these wild swings in prices.
Clay, as part of the Titan platform, you post helpful videos to the platform to help investors understand how to invest, what to do, and what not to do. What are some of the biggest questions you're getting from clients right now as we head into the year?
It's a great question. I mean, I think the volatility over the past several weeks has been quite stark. And one of our investment analysts described it as a very non-ergodic, which basically means very calm on the surface, but a lot of rumblings and waves underneath the surface. I think it's a perfect way to describe the markets for the past few weeks. So our clients are asking us questions like, what's happening? What are we doing about it at Titan, if anything? And, how can we be positioned heading into the new year? Taking this piece by piece, I think it's been macro concerns around inflation, the FOMC meeting tomorrow, and accelerated tapering. And obviously that's hit the very long duration growth assets, highly valued software as a service stocks, for example. And a lot of these are great businesses. So a lot of these are in the Titan portfolios, and our portfolios have not been immune. So naturally what we're doing about it is we are reining in some of that exposure. So we've trimmed a lot of our high valuation names in software and other growth sectors. We've redeployed and invested into industrials and healthcare. I think those are particularly interesting from an inflationary resistance and secular growth standpoint. And then we've also raised some strategic cash. So we actually do have some dry powder, more dry powder than we've had in months, perhaps years. And we plan to deploy that dry powder once the dust stuff starts to settle, and once we believe we're in more of a risk-on environment. But we're staying put for now. I do think there could be more volatility coming up into the new year.
Hey Clay, I want to take a step back for a minute for people who are not familiar with Titan. So you guys are an investment platform. You're sort of a startup investment platform. What makes you different from a traditional money manager?
I mean, it's a great question. I would say we think of the state of retail investing today as sort of caught between two, unseemly poles. One pole is the world of unaffordable, old world wealth management. So you can think about like private wealth advisors that typically have $1 million minimums. You have to walk downtown to the office, make an appointment. And even then, if they ever make any trades or updates on your behalf, it's likely a PDF prospectus in the mail. The other pole is what we liken to sort of casino-like gambling or day trading. It's folks spinning their wheels, trying to get rich quick, and doing it themselves. And we kind of view that as akin to having a keys to a Tesla without having gotten a driver's license. And so where Titan comes in is we're trying to give everyone a team of investment experts in their pocket for as little as $100. And so what we do is we basically recruit a team from buy-side and sell-side firms in the investment world, and we build and manage actively managed portfolios on behalf of clients. And we do it via a mobile app. That's why we decided not to launch a mutual fund or launch an ETF, is we want to have a direct relationship with clients. So if you open the Titan app today, you're likely to get a quick audio note on our take on markets, perhaps a trade update on any positions we're making in crypto or equity strategies. And so, we have 40,000 clients today, and I think many of them will feel like they have a personal relationship with myself and my team at a fraction of the cost of traditional managers, which I think is really exciting.
Clay, how large is your crypto business?
Yeah, we haven't disclosed the assets volume of crypto business. It's definitely outpaced our expectations, I can say. We've done it, frankly, with one arm tied behind our back, in the sense that, we have yet to really dive into some of the interesting value-added services that I think are going to become pretty par for the course in crypto over the next few years. So, staking, having some participation in the NFT world, those are features that are on our roadmap, that are on our mind, but, have not yet been launched. And so, tremendous growth in the assets into Titan Crypto. I think it speaks to the fact that a lot of retail investors see crypto moving up and to the right, you zoom out, and want to participate in this thing called cryptocurrency and blockchain, but either don't have the time, don't have the resources, unsure what coins to buy. Frankly, even just having an on-ramp, there's security concerns, there's ease of use concerns, there's a lot of frictions. If you're a retail investor and you want to get involved, and I think Titan's been able to solve that by making it as simple as joining the app in a couple of minutes, pausing as little as $100, and setting it and forgetting it by many means.
Clay, thanks for coming on. Good to catch up with you. Clay Gardner is Titan co-founder and co-CEO. Thanks for being here. All right, when we come back, we are going to be talking electric vehicles with Brian Gu of Xpeng. Stay with us.
You're watching shares of Chinese EV company XPeng as it gears up for a big slate of innovation in 2022. Despite that, however, shares have been under pressure along with others in the space as Didi plans to delist from the New York Stock Exchange. Joining us now from the New York Stock Exchange to discuss the state of the company and autonomous space is friend of the program, Brian Gu, President and Vice Chairman of XPeng Motors. Brian, always nice to see you. Normally you're coming to us from overseas. What brings you to New York City?
Well, after 2 years of, I would say semi-lockdown, I think we're finally able to travel again. I'm so eager to come to the U.S. to see our colleagues, see our friends, our investors, and this is a trip for me to actually meet a lot of my, colleagues in person. So I'm very excited to be on the ground here.
Brian, we last talked with you around your Innovation Day, and one thing we didn't get to, we'd love to get to it now though, your X-Pilot 4.0. What is that, and when will it start hitting the market?
Well, we unveiled X-Pilot 4.0 at our Tech Day. That's a software that will be upgraded by early 2023. This is actually going to be embedded in our fourth product, which is the G9, the premium SUV one unveiled in the Guangzhou Auto Show last month as well. It will have a brand new architecture with cutting-edge computing chips, from NVIDIA. It also has probably the most extensive sensor packages on a production vehicle. So our goal is to use X-Pilot 4.0 to enable end-to-end city-wide NGP, which means that you can basically turn on the autonomous driving capability and drive around the city for most of the scenarios that you see.
Brian, certainly that's not the only electric vehicle that's being sold in China right now. We just got the Chinese auto sales for November for electric vehicles, 427,000 cars. That's 19.5% of the total passenger sales, car sales in China, which is incredible to me. So talk to me about the industry there versus what you're seeing from the industry in the US, where you are in the growth cycle there, and how much for example, the Chinese government has been instrumental in that growth.
Well, this year we certainly saw an explosion of EV penetration. So let's say a year ago, it's roughly 5% penetration. And as the late figure, as you mentioned, is close to 19%. So that's a dramatic increase over the course of probably 15 to 18 months. And this is not just the government policies at work. I think that really move this penetration rate is actually the availability of very good smart EV products coupled with acceptance and also people's actually, the user behaviors that actually welcome these products. Because the subsidy in China actually has come down pretty dramatically from 2 to 3 years ago, and this has become a very small portion of the sales price. But the product right now is selling very well, and so on is due to because product strength. At the same time, I think also you saw the infrastructure, allowing usage of EV is also blossoming in China. The number of charging stations and also the toll roads and also the city roads are also really geared to welcome more and more EV usages. So the combination of these factors really propelled the conversion in penetration rate.
And I'm also curious, obviously we have seen this global push to address climate change, to bring down emissions. And what you're doing in the electric vehicle industry there is a part of that. How confident are you that or are you already seeing a decrease in pollution, for example, in China as a result of this shift?
I think EV industry is definitely a very key component to decarbonization because we are producing zero emission vehicles, but also we actually focus on manufacturing processes starting from the raw material to be as green as possible. So that's why if you look at in our plant, we are basically utilizing a lot of these recyclable energies and waste treatment techniques to reduce carbon footprint. So one of the things that we're very proud of is that X-Pilot is ranked AA by MSCI in the ESG rating, really reflective the commitment that we have on this energy front.
Brian, I read something recently that XPeng is rolling out superchargers that will let you charge up your car in about 5 minutes. Is that right? And how many of those will you have in the market next year?
Well, this is actually a part of the technology will be in our fourth product, which is the premium SUV G9, which will be start delivering the second half of next year. It will have the cutting edge powertrain design that enable 480 kilowatt charging, which actually allows you to charge up to 200 kilometers in about 5 minutes. That requires, obviously, we built new charging piles that is enabled by this technology, which coupled with our automobile battery designs. We are aiming to deliver that experience to our customers by the end of next year.
And we mentioned in the intro, Brian, lots of focus in this space on DD delisting. From an XPeng standpoint, do you have plans to delist from the New York Stock Exchange?
Well, we don't have plans to delist at all. We're still enjoying, I would say, very active trading of our shares in the U.S. Stock market. But we are closely monitoring, obviously, the development of this proposal by the SEC and how in a few years what exactly will lead to at the end. But as a company, we're fully prepared for any eventualities. We have successfully completed our Hong Kong dual primary listing this summer. So we actually are able to independent trade with or without the New York Stock Exchange listing status. But what I would say is that most of our shareholders are large institutional investors who actually are able to invest in both stock exchanges. So we don't think there will be a lot of problems or issues if there's a change of listing venue.
All right, well, good to see you down there, Brian. Enjoy your trip and time in New York City. Brian Gu, President and Vice Chairman of XPeng Motors. We'll talk to you soon. And we'll be right back.
Should we call this Whipsaw Day, Brian Sazzi? That's what it feels like. A number of individual stocks that we are watching today that have changed course over the course of the session or have reversed in recent days. Let's start with Peloton, because that happened over the course of the session here. So this stock fell earlier after Bloomberg cited a report in the Digitimes that the company was halting new product development for 2022. Then Bloomberg came out and cited a Peloton spokesperson as saying, no, it's not a true report, it is false. And then the stock turned higher once again. But of course, this comes on the heels of a very few active days for Peloton after, of course, that Sex and the City offshoot show showed Mr. Big dying after he rode on a Peloton. I think we can dispense with the spoiler alerts at this point. Then Peloton came out with an ad with Mr. Big, i.e. Chris Noss, and the Peloton instructor saying, no, he's not dead after all. It sounds sort of ridiculous to describe all of this, but it has resulted in a lot of volatility in the Peloton shares.
Julie, I'm over it a little bit. I think this is we're starting to move beyond this, and as we should, I think the focus should return on what Peloton puts up in terms of its holiday quarter here, and there remains a lot of concern. Can the company meet its numbers? It has had a very challenging past 2 quarters. Earnings estimates on the street continue to decline or continue to fall here. So it will be interesting to see how they perform this quarter.
Are you giving all of your loved ones a Peloton with a big red bow for
a little too much money for me, Julie. A little too much money for me.
Yeah, I've got the app and I'm canceling it, I got to tell you. So that's one reversal that we've seen. Another reversal to the upside today has been Beyond Meat. The shares are up 7% today. And this has to do with an upgrade from Piper Sandler. It's just going to a neutral from an underweight. So it's not even going to a buy. But the analyst over there did say a nationwide launch at McDonald's could be coming late in the first quarter of 2022, which is earlier than the analyst there had anticipated. I mean, it's amazing here, the speculation that has surrounded Beyond Meat's various partnerships with fast food outlets and how sustainable those partnerships are going to be.
Yeah, so you saw Beyond Meat come out yesterday, Julian, shoot down a report that Taco Bell is not really working as close as possible with them. So Beyond Meat, and I should say Taco Bell coming out with a statement yesterday, shooting down the report, I believe it was from Bloomberg. But look, a nationwide launch of a Beyond Meat burger patty next year at McDonald's would be incredibly bullish for this company. So again, not surprised to see this market reaction.
It would be, if it happens. So that's what we kind of have, because like I said, this is a lot of this stuff is rumor and speculation. We don't get actual concrete announcements from the company. So we'll see if we indeed do get them. Another theme that we are watching today that you are fired up about is what's going on with GameStop and AMC. Look at this. They're flaunting it in your face here, Brian Sargi. Stocks have been tumbling. They're both down still more than 40% from their most recent highs. They were down earlier, but look, now they have turned higher. And we have seen in the past, I'm not saying that's what's happening today, but we have seen in the past sort of a concerted effort to short squeeze in these shares. I don't know if that's what's going on. I don't know if they've just got too low of a point and we're seeing some buyers come back in, but it still remains a fascinating story to watch.
Yeah, they're just really just flipping 2 birds of me here, I'd say, Julie. But look, this is not aggressive buying. Both these stocks fell double-digit percentages yesterday. You're not seeing the bulls really run in here and buy that dip. I would say the trade remains bearish.
Yeah, we'll see what happens. I mean, as we know, the fundamental story and the actual trading story and how the stocks move are pretty divorced from each other. But we'll see what ends up happening with these. But sort of on a related note here, Robinhood has also been selling off very sharply. And we've been talking about the stickiness of the so-called meme investor or retail investor here. We definitely have seen at the traditional brokerages, people still opening new accounts at a very rapid rate. At least we were in the third quarter. Fidelity seeing still a lot of growth in new accounts. But Robinhood, as the company that has been most tied to the meme stock trade, perhaps not surprising that it is seeing volatility here as the meme stocks see volatility.
Yeah, and the stock slide has continued, Julie, really. This has been going on almost 2 months here with Robinhood, but it is interesting in the context. I would have thought volatility and increased volatility in the markets would be good for Robinhood, increased activity on the platform, good thing for them, but the market is saying otherwise.
It does seem to be. And then finally, as we look at our various trending tickers, Doge on the top of the list on the Yahoo Finance site today. And that's after Elon Musk was talking it up once again and saying that Tesla was going to allow transactions in Doge, not necessarily for its vehicles, but for the other stuff, the swag that we see Tesla selling on its site. And so Doge is getting a pop here, and it's a pop that is after a whole lot of nothing for that meme coin. Tesla shares themselves have been falling as we have seen Elon Musk continue to sell shares, but not the case with Doge here. I guess, we're talking memes again. It's like, I feel like we're back in February. Tesla, Doge, memes.
We are about to go into the new year, but it'll be interesting to see. I think we talked about it last week to see if we will see that type of activity in January next year as we saw last year in the markets.
We'll see what happens. All right, that's it for Brian and I today. And just wanted to mention as well, Brian, you're going to be talking to the interview. You're going to be talking to the CEO of Harley about that electric bike spinoff. That is at 1:45 today. That'll be very interesting to see, what he has to say about that deal. Kiko and Zach are going to take you through the next 2 hours of trading here on Yahoo Finance Live.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. We are 90 minutes into the trading day and we're seeing stocks in the red right now as producer prices soar at the fastest pace on record. Taking a look at all three major indices, all in the red right now, with the Nasdaq seeing the steepest losses, down about 1.7%, the S&P 500 down 1%, and the Dow down about 0.5% there. The inflation reading, by the way, adding to concerns about the Fed's taper timeline as the central bank kicks off its two-day policy meeting. Elon Musk continuing to unload his stock. Shares of Tesla is fighting as Musk sells another $906 million in shares, but Dogecoin spiking on a big announcement from Musk and Tesla. We'll dive into that a little later in the show. And crypto expanding its footprint in basketball. Crypto exchange FTX announces a multi-million-dollar sponsorship deal with the Golden State Warriors. Warriors president Brandon Schneider and the president of FTX US is going to be joining us to discuss the new partnership later this hour. First, though, we are beginning with that new data out from the CDC, pointing to just how quickly the Omicron variant is spreading here in the U.S. Director Rochelle Walensky saying new COVID strain has been detected in more than 30 states now. Let's bring in Yahoo Finance's Anjali Kamlani, who's tracking the very latest for us on that front. Anjali.
That's right, Akiko. And not only is it now in 30 states, but we're tracking it alongside Delta. And Omicron is really growing pretty rapidly. As studies show that it has a doubling rate of 2 days, which is quite significant compared to previous strains. CDC Director Dr. Rochelle Walensky did also say that it now accounts for 3% of all COVID cases, and especially here in the Northeast, New Jersey and New York, accounts for 13%. So that's a pretty significant jump in the last several weeks and points to some more gene sequencing of the variant.
Actually, too, I mean, when we talk about the growing tools against all this, that's another one we're watching when it comes to Pfizer and everything else in this battle against Omicron. New data there, I think, when we're looking at maybe how impactful some of these things are.
That's right. We're looking at the several things. So Pfizer has, of course, this pill that it has been looking at the data for, and it has also applied for an emergency use authorization. We got word today that it does stand up to the preliminary data that they did provide, which includes 89% efficacy if the pill is taken within 3 days of symptom onset, and 88% efficacy if taken within 5 days of symptom onset. So that's pretty strong data right there. And it is taken as a 5-day course, the pill. They are waiting for word on whether or not the FDA will continue and set up a meeting or authorization of that. As a side note, Merck also does have a pill, which did have an advisory meeting on, but no word yet on whether or not the FDA will push forward that. Data was just a little less effective than what we're seeing here with Pfizer. Also, we got information from South Africa, which shows that the Pfizer vaccine is 70% effective against Omicron. So it's really promising news on that front, and really holds the key to what we're discussing when it comes to boosters, especially looking at the global picture. Cases are on the rise. We know that we're seeing some hospitalizations, that first death reported in the UK, prompting some more restrictions in many European countries like Norway, for example, and Germany. They're facing some pushback on those. The UK in particular looking to stricter lockdowns, and they're varying degrees. Most of them are following what happened in Germany, where anyone who is unvaccinated, for example, faces stricter restrictions. So that's where things stand right now.
Yeah, those Pfizer headlines you just pointed to, providing a lift to the stock. Shares hitting a new high in the session today. Anjali Kamlani, thanks so much for that. Well, Treasury yields are edging higher as the Federal Reserve begins its 2-day policy meeting. All eyes will be on the central bank's taper timeline, with new data this morning pointing to increasing price pressures building. Let's bring in Yahoo Finance's Brian Chung, who is tracking this for us. And Brian, it's not just about the taper timeline, but the language from the Fed, especially after Jerome Powell essentially said inflation is no longer transitory.
Yeah, well, we're going to have to watch very closely the statement that we're going to get tomorrow at 2 p.m. from the Federal Reserve regarding their characterization of where the economy is. We should expect some major changes because if you'll recall, the Fed's last meeting in November, the statement described inflationary factors as being transitory. But as you mentioned, it wasn't long ago, only about 2 weeks ago, when he told Congress that they would be retiring, or at least he would be retiring, the use of the T word in describing transitory. But it's very interesting to see what's happening specifically in the bond markets with regards to the pricing expectations for what to see from the Fed tomorrow. You can see ahead of you, the 10-year yield is actually at about 145 handle right now. But what's interesting is that that represents about a 20 basis point decline just over the last 2 months, during the time which the Federal Reserve was actually messaging its intention to maybe get a bit more aggressive with the pullback in monetary easing that they've had since the depths of the pandemic. Now, normally if the Fed is saying, hey, we expect to see interest rate hikes not long from now, you might expect the longer end of the curve in the 10-year or the 30-year to start hiking a little bit. But instead, we've actually seen a decline in yields. And what's also very interesting is to see the spread between the 2-year and also the 10-year yield. Now, again, this is usually a good measurement to see where sentiment is going. If you see higher yields on longer term bonds, that means a little bit more optimism over where the economy might be in the medium or longer run. But actually, the spread between those two securities has actually narrowed over the last few weeks. You can see actually the 10-year yield and the 2-year yield have gotten a lot closer with one another, not necessarily to negative rates, which is usually a harbinger for recession, but certainly flagging a little bit of concern. So what's one interpretation? Well, one concern is that the Fed might have to get more abrupt on raising interest rates to get ahead of the curve on inflation, which could actually put the economic recovery to an end and maybe force the Fed back into an easing cycle. You can see the spread chart now ahead of you. So that's certainly one interpretation of that reading. Definitely something the Federal Reserve doesn't want as it starts to think about raising interest rates sometime next year. We'll see if the Fed can start to steepen the curve with perhaps some jawboning or maybe some language hinting at interest rate hikes in that press conference tomorrow at 2:30.
And Brian, volatility has obviously calmed down, I guess, a little bit. We're also going to get those quarterly projections. So we look often at when it comes to what they're expecting on inflation and interest rates in the future here. I mean, when you look at that, I'm not sure which one might matter more depending on what we hear from Jay Powell when he steps to the mic. Obviously, the market has been increasingly weighing on every word, especially since he stays transitory from his vernacular. I mean, what are you going to be listening for, I guess, out of his mouth when it comes to all of those expectations, how the market might react?
Well, to be quite honest, I actually think tomorrow could be a very dicey press conference for the Fed chairman because he's got a lot of things to balance there. Because on one hand, we are still very much still in the recovery, and the fact that we haven't already raised interest rates kind of reinforces the Fed's view that there's still some progress to be made, at least in the labor market, where we've seen over at least almost 4 million people still out of the labor force compared to pre-pandemic levels, as verified by the November jobs report that we had gotten about a week and a half ago. Now, on the inflation side of things, the Fed already acknowledges that this is not transitory, that this is becoming a bit more worrisome, and that it could end up being more persistent, which is the reason why they want to give themselves the optionality to raise interest rates perhaps earlier and perhaps more aggressively next year than they had originally messaged in the middle of the year. But that's going to be a really difficult thing to message, especially given where bond markets are pricing right now. They really are pricing in the expectation that the Fed is going to be too late and is going to have to pump the brakes, raise rates too aggressively. That would ultimately just put a hard end to the recovery. So no soft landing. Again, we'll see if bond markets maybe reprice depending on that commentary tomorrow, but it just shows how sensitive things might be as we head towards that 2 p.m. statement tomorrow or that 2:30 press conference tomorrow as well.
Okay, we'll be watching. Brian Chung, thanks so much for that. Let's bring in Art Hogan, National Chief Market Strategist. And Art, you just heard Brian kind of break down his read on the bond markets. I'm looking at the 10-year yield right now at 1.43. We've also seen the 30-year yield move too. What does that tell you about the expectation in the market?
Yeah, I think Brian did a great job of breaking this down and talking about the spread between the 2s and the 10s. But the way we look at that really is the 2s tend to be a reflection of where we suspect monetary policy is going, and the 10s tend to be a reflection of what we think the pace of economic activity is. So that's why that's tightening right now. We suspect that that is likely going to pull with their summary of economic projections and their dot plot's going to pull some of those rate hikes that were sitting in 23 the last time we got to see a fresh dot plot into 22, right? So that moves the 2-year, the front end of the curve up, while we also suspect that there's going to be some modicum of economic slowdown because of the Omicron variant and the things that we're hearing about it. So, much more contagious, but likely much less virulent. So I think that we're concerned about the pace of economic growth going forward. At the very same time, we know we've got a tightening in front of us. So, to Brian's point, the Fed's got to walk a fine line here to deliver the message that says, here's what we're thinking about monetary policy. We think we're going to taper a little more aggressively, at 15 billion a month to something like 25 or 30. And that'll shorten the time period with which it takes to get to the end of that process. And I certainly think they're going to lean into the fact that, hey, it looks as though we're pulling a couple of those dots into 22. So that'll signal that the Fed sees a couple of interest rate hikes this coming year. That'd be different than the last time we had a SEP or some of the economic projections. And I think that balancing act is what Jay Powell really needs to navigate, especially as he works his way through the presser, because it's going to be all of a sudden, hey, did you get this wrong? Are you behind the curve? Do you have to hurry up the pace? And clearly, they've already admitted that, right? They're going to taper faster and likely still keep some separation between the end of the taper and the first rate increase, but that happens sooner than we had consensus estimates for 2 weeks ago.
Yeah, and Bart, I mean, when we look at maybe how the market's been reacting to all this too, right? Technology once again taking it on the chin today, whether you're looking at the NASDAQ or just kind of the sector action we're seeing in the S&P 500. Adobe, one of the biggest losers there too, and they're reporting earnings later in the week. I wonder how much of that is tied to maybe the rate expectations there, what it means for growth names, or maybe if we're just seeing some profit taking at year end. Obviously, always kind of tough to tease this out, but what's maybe the takeaway for investors as they ramp up and look to allocate in 2022?
Yeah, Zach, that's just such a great question. And when you think about technology, we've got the Nasdaq Composite, which is only about 5% off its all-time highs, right? But if you lift up the hood a little bit and look at the average stock in the Nasdaq Composite is almost 40% from its all-time highs. And that just is an expression of just how much growth has been re-rated lower. And what happens when you have an anticipation of higher interest rates, growth stocks or long duration growth stocks certainly get hit the hardest. So when you do that net present value calculation with a higher interest rate, that implied multiple or ascribed multiple to growth names comes in. So a lot of that's been priced in. When you think about some of the real growthy names and momentum names and risk assets, they've seen a lot of carnage, and that's been happening since the peak in November. So I think that what the market's trying to tell us here is that when you set your asset allocation plan for next year and you want to have a barbell approach with growth on one side, you want to have those growth names that are actually valued at a multiple to earnings, not a multiple to revenues or a multiple to cash flows or a multiple to sales. And that's the problem. Multiple to sales and multiple to revenue names are going to continue under pressure until we get to that terminal rate of where the Fed stops raising rates. And the market's gotten way out in front of that right now. And there's been a lot of damage in a lot of those growthy names.
Let's talk a bit more, Art, about what that allocation should look like. You've obviously highlighted the importance of diversification, especially in the face of uncertainty around Fed policy. You've talked about the growth names. So what are some other sectors do you think investors should be adding exposure to right now that offer particularly good value?
Well, we anticipate 2022 is going to be very much like 2021, where you really want to have a balance between growth and value. And as I mentioned, you want that growth to be an expression of thematics like 5G and cloud computing and cloud security, but you want those expressions to be in a PE, not a price to sales type name. So you're more traditional of your growth names in place. On the other side of that, we really think the economically sensitive cyclicals are going to do very well. We think that the two sectors that are the most economically sensitive and cyclical that should be on the other side of the barbell clearly fall into the energy and financials. And I think both sectors have a lot of runway in front of them. But what's important is with all of the rotations we see throughout the course of the year, you want to make sure you keep that barbell balanced. You want to make sure every couple of months you're looking at this and saying, am I still balanced between both growth and cyclicality? And if you do that, you outperform the S&P 500 this year, and I think you'll do it again next year. And it's diversified, but it's also rebalancing on a regular basis.
Art Hogan, National Chief Market Strategist, joining us there. Appreciate you taking the time once again, sir. Hope to chat soon. I want to turn our attention to one stock we are watching in today's session, though. That would be shares of the total meat maker Beyond Meat, popping by more than 7% off an upgrade at Piper Sandler. Analysts there triggering a break from their 3-day losing streak. We've been watching Beyond Meat shares off a bit. But analyst Piper Sandler optimistic, raising the stock to neutral from underweight, forecasting a nationwide launch at McDonald's could be finalized within less than 3 months. And of course, that's a deal we've been watching and waiting for. A lot of people optimistic that would have come sooner. But Piper Sandler saying that it could be less than 3 months away. You look at the stock, Beyond Meat, you back up just a little bit there. Obviously not doing so well in the last 6 months, off by more than 50%.
Yeah, that is a tough chart if you're an investor in Beyond Meat. Thanks so much for that, Zach. Coming up, we've seen Dogecoin spike on news from Elon Musk, while shares of Tesla are sliding after the founder, or Tesla's Elon Musk says that he is selling his shares there. We're going to break down the Musk trade after this break. Welcome back to Yahoo Finance Live. Dogecoin spiking nearly 20% after Tesla CEO Elon Musk said the company will start accepting the coin as payment for some merchandise. This after Musk said Dogecoin is better for buying things than Bitcoin. Zach, important to highlight here is just about the merchandise, not necessarily the Tesla cars. But at this point, when you look at some of the moves in Dogecoin, I feel like we should just put Musk's face on it. Right? I mean, how I would like to go back on this year and see how many conversations we've had tied to Elon Musk's comments and Dogecoin's moves.
Well, we've had a lot. It would take us probably the whole show to do that, Akiko, and to look back on 2021, just because, you know, I mean, it hit a peak. Let's not forget, it hit a peak back when he was hosting SNL, too, right? So, I mean, and a lot of people in the Doge community were very excited about that. And then it sold off right after he came off the set there. But yeah, I mean, it's interesting to see another kind of move here to accept. Some people might look at this and say, well, it's inching towards Tesla eventually accepting Dogecoin for its cars, which obviously would be much more impactful than just the merch on the site there, Kiko. But still, I mean, it's been a volatile year for Dogecoin. You and I have talked about kind of some of those early Doge players who really held on and not sold when it was closer to about 75 cents. Compared to where it is now, just under 20. So, I mean, it's been a pretty wild year, but I think this is, I don't know how important this is, because you also had, you know, the Mavericks also kind of flirting with accepting cryptocurrency like this too. So, I mean, I don't know. I mean, it gets the community fired up at the very least.
It's certainly gotten those holders, those who trade Dogecoin, fired up. But I'm curious what you make of this comment from Elon Musk that Dogecoin is actually better for buying things than Bitcoin.
We've seen a lot of people shift away from the idea that Bitcoin is ever going to be used for transactions. That's been the case probably since 2 years ago. They kind of gave up on the idea of that, although lending and the network built on top of Bitcoin is still making strides, as we've seen in El Salvador, and obviously there is a capability to accept it for payments if you truly wanted to. I just feel like, you know, what we've seen in other pieces of the crypto market, particularly when it comes to stable coins, that seems to be the direction that the major players in terms of the payment networks themselves might be looking to go. We've had Terra on before. They got Chai set up in South Korea that's already kind of perfected the payment strategy around that. So, I mean, there's a couple different ways to go. It does still seem, though, as we showed on the chart, Dogecoin is still, you know, just as volatile as some of the other crypto names out there. So in terms of being maybe the best suited for transactions and using it to pay itself, I'm not entirely sure. Maybe it's a step above Bitcoin if you really want to look at it that way. But clearly Elon Musk does, based on all the tweets that we've seen there and the move to start accepting Dogecoin too.
Yeah, let's talk about shares of Tesla. I mean, we're talking about Tesla accepting Doge, providing a lift to Doge, but Tesla shares today sliding in the session down more than 2% on this latest news of Musk unloading some of his assets. This is a story we've been following, and it really is not just about Elon Musk, but these billionaire executives who've been unloading their own company shares at record levels here. The very latest here being that Musk has now sold another $906 million in shares. And Zach, we were talking last week specifically about what has motivated this record selling from executives, whether that is the threat of increasing taxes. In the case of somebody like Satya Nadella over in Washington State, it's about state laws and tax laws there as well. But interesting to see these moves because, you know, everything we have heard has been specifically that it's not about material knowledge they have internally, but more about the tax burden that could be waiting on the other end with new laws going into effect in 2022.
Yeah, and I'm sure there's a number of investors out there who are watching their Tesla stake maybe come down a bit, saying, look, why don't you just get this over with? Because, you know, it all kind of dates back to that initial Twitter poll we saw from Elon Musk talking about trimming his ownership stake in the company by about 10%. And he's on his way to doing that. Still has a bit more to go, though. But if you go and tally, I guess, over the last 5 weeks, how much he's been selling, now $12.7 billion worth of Tesla stock. So, I mean, it's not done yet. He's still got a ways to go to hit that 10%. I think he's, a couple percent away from that goal. So, I mean, the selling might continue here. Interesting to see, though. I mean, we looked at those other names. You talk about the big CEOs of the other tech companies have not necessarily seen kind of the pullback that Tesla has based off of it. But I guess it speaks to maybe the je ne sais quoi, shall we say, or just the high profile that Elon Musk has now attracted, given the fact that he's Time Person of the Year, given the fact that we talk about him so much, that maybe his sales, or rather, him ditching his company's shares, carries a little bit more of a spotlight than what we've seen from other tech CEOs out there that maybe we don't talk as much about. I'm not sure either way, though, it changes the fundamental case for any company you're looking at there.
Yeah, I mean, there's a bit of a good and a bad in that, but I would argue no founder, CEO more tied to their own stock than Elon Musk. But of course, Tesla shares still up significantly on the year. Coming up, we're taking a look back on the year for crypto, the biggest regulatory headlines and the global adoption that we saw. That discussion is on the other side after this short break. Well, it has been a historic year for crypto on many levels, from El Salvador adopting Bitcoin as legal tender to the explosion of NFTs and the debate over regulation. So what exactly does all that mean in terms of what's in store for 2022? Let's bring in Emily Parker, CoinDesk Global Macro Editor and anchor there. And Emily, before we came to you, before the break, we were talking about Elon Musk, the spike that we saw in Dogecoin. I mean, does that pretty much sum up what we've seen over this last year?
Yes, I feel like what just happened with Elon Musk in some ways is the most 2021 crypto story ever, because it has all the ingredients. It has Elon Musk, who has been moving the market pretty much all year. It has Dogecoin, which symbolizes the rise of meme coins, which has been such a big part of this crypto story. And it also has the role of Tesla, because we've seen these big companies come in and really also have an impact on Bitcoin's price. So if you remember, this feels like decades ago, but early in February, earlier this year in February, Elon Musk announced that he was buying 1.5 billion in Bitcoin, and that Tesla might eventually accept it as a form of payment, and that set Bitcoin soaring to a record high. And I think that kind of set the stage for a lot of what we saw in 2021, which were, these big companies getting involved, big players like Musk moving the market via social media. And again, in this specific case, we also saw the rise of meme coins, which is really an important part of the crypto phenomenon, because now it's not just Dogecoin. You also have Shiba Inu, which according to CoinDesk data, I think is up something like 43 million% year to date. So this is a big part of the crypto story in 2021.
And Emily, I guess the other big story that we've been following is kind of regulation and what regulators here, at least in the U.S., want to do about it. And, obviously Elon Musk talking about Dogecoin maybe being a better form of payment than Bitcoin here. You still got stable coins that could potentially be an even better form of payment, depending on how regulators want to go. Of course, the Senate Banking Committee also underway with their hearing after the House had theirs on stable coins and crypto. I mean, what's maybe the story to watch there if regulators do want to clamp down on stable coins, how it changes the entire market in 2022?
Yeah, so as you said, there's a hearing happening today on stablecoins, and I think there's two important trends in this story. One is that stablecoins are officially on the radar of Washington lawmakers. We are definitely going to see more regulatory action towards stablecoins in the future. That seems certain. The other is that it also is just an example of how crypto in general now is part of the debate in Washington, and that's a relatively new thing, at least to this level. We recently had a hearing with cryptocurrency exchange executives also testifying in Congress. We saw the infrastructure bill partly held off by a controversial crypto tax provision. So, having this relatively sophisticated debate about cryptocurrency in Washington, again, I think is something that is relatively new and very important in terms of how regulations are going to be framed.
And Emily, I guess you could argue that in many ways that regulation that's about to follow is going to inform the growth in the crypto space. But we're coming off of what has been a banner year. Are we likely to see that kind of growth in 2022? I mean, there's two stories here. One is the adoption story, but the other is really just the sheer growth that we have seen in terms of the value.
Cryptocurrency markets are always anyone's guess, but I would say that we are likely to see growth continuing. And also, regulations are important for growth, because what is not good for crypto markets is a lack of clarity or uncertainty. So, for example, in the United States, you'll often hear people complaining that U.S. regulations are just not clear enough for the cryptocurrency industry. So, obviously, we don't want over-regulation, but I think there is a general consensus that clear regulation and clear guidelines are probably going to be good for the cryptocurrency industry in the United States. And the United States is a very important player in this market.
Okay, and I know you'll be watching that very closely. Emily Parker, always good to have you on. Thanks so much for joining us. Coming up on the other side of the break, yet another report of an Omicron case over in China as separate outbreaks suspend operations in some factories there. Plus, a bus explosion in Haiti kills more than 50 people there. That's all coming up in our worldview. our worldview today, China has confirmed its second case of the Omicron variant, raising fresh concerns about the country's ability to control the spread just months out from the Beijing Olympics. Officials say the patient in the southern city of Guangzhou recently traveled from overseas and had just completed the mandatory 2-week quarantine. The patient was diagnosed just hours after China's first Omicron case was reported in the city of Tianjin. This comes as multiple COVID outbreaks in the eastern province suspended operations in one of the country's largest manufacturing hubs. Meanwhile, over in Europe, Norway has become the latest country to reimpose tighter COVID restrictions. The prime minister there announced a ban on alcohol in bars and restaurants and closed all gyms and swimming pools to discourage activity. The country has also said it will speed up vaccinations to limit the spread of Omicron. An explosion involving a fuel truck has killed more than 50 people in Haiti. The accident happened overnight when witnesses say the truck overturned the second largest city of Cap Haitian. The blast also damaged homes and shops nearby. Fuel trucks were banned from loading at Haiti's main ports for nearly a month to curb the wave of violence brought on by gang activity. Deliveries had just resumed last month. The government's declared 3 days of mourning. And a court in Belarus has sentenced a key opposition leader to 18 years in prison. Sergei Tikhanovsky organized large protests against President Alexander Lukashenko and planned to challenge the dictator in the presidential election last year before he was arrested. Tikhanovsky was convicted of organizing mass arrests and inciting social hatred in a trial that was widely characterized as a sham. He faced trial with 5 other opposition activists who received sentences of 14 to 16 years in prison. Tikhanovsky's wife questioned the legitimacy of the court case, telling the BBC her husband's sentence amounted to personal revenge by Lukashenko. Coming up after this break, the NBA doubles down on crypto with a new partnership between the Golden State Warriors and crypto exchange FTX. Warriors President Brandon Schneider and FTX US President Brett Harrison is going to be joining us after this commercial break. We'll be right back. crypto exchange FTX has expanded rapidly in the world of sports, securing the naming rights to Miami Heat's arena, a jersey deal with Major League Baseball, and then the naming rights to Berkeley's Memorial Stadium. Now it is adding the Golden State Warriors to that list in an international rights sponsorship deal, reportedly worth well over $10 million. Let's bring in Brandon Schneider, President and COO of the Golden State Warriors. We've also got Brett Harrison, FTX U.S. President. Brandon, let's start with you. I mean, this is a big deal for the Warriors. You've obviously been known as the team of Silicon Valley, well versed in tech. Talk to me about why you decided to go for this deal, why it made sense, and what exactly it entails.
Yeah, so we're super excited to be partnering with a global leader in the space like FTX. We've been buying NFTs and cryptocurrency for many months, which sounds like not very long, but in this space it is a long time. We were actually the first sports team to launch to do an NFT drop in April, so we're really excited about that. So we've been looking at the right partner moving forward, and FTX is already a global leader and aligned values in terms of where we're headed. In terms of what the deal entails, there are our official cryptocurrency platform as well as our official NFT partner. So we're really excited about that. We'll be marketing the deal globally, which is great, a new opportunity that the NBA has opened up. And the other thing that's important to us is they're very community minded, as are we. And so as part of this launch, we're donating free Bitcoin to 3 local nonprofits through our foundation, which focuses on educational equity and youth development here in the Bay Area.
Brett, I'm curious to get your thoughts here. I mean, I'm always joking that I watch a lot of games, and whether it's in baseball or basketball, you can't escape the FTX logo in some way. Talk to me about this expansion in basketball and why it's made sense for you.
Yeah, we're super excited to partner with the Warriors. It already made sense. We had this partnership with Steph, and it just made sense to get the whole team involved too. It's obviously one of the best teams in the NBA, very community minded. We're really excited to partner with them on their various charity efforts, their philanthropic efforts. There's also more than just the basketball team. We're also working with their esports side as well. We launched our NFT platform pretty recently, and we're excited to partner with them on all the opportunities there. So in general, it's just a great partnership, and we're really looking forward to all that it has to offer.
Yeah, Brett, good chat with you again, man. I wonder, too, how much of this was just kind of led by what the Warriors demonstrated thus far with kind of their ability to do NFTs on their own. I mean, we saw the rings that were sold earlier this year, pretty phenomenal stuff. I mean, was this kind of a no-brainer? Obviously, you already have a relationship with Steph Curry, but I mean, when it comes to like pairing with a team like the Warriors and the established, I guess, NFT history they got, was it hard to choose which teams you wanted to go with here?
Yeah, that's a really good point. FTX, we're doing all these great, branding exercises with, some of the best talents in the sports industry, but we're a technology platform, and we want to partner with teams and with people who understand what we can bring to the table as a technology platform. So it's not just about our name. We have this great NFT platform. We're a global leader in cryptocurrency. We're pushing into other asset classes as well. And we want to work with partners who are excited about what we have to bring to the table in that area. And it's clear that the Warriors get this technology. Before the FTX partnership, they're dropping NFTs. They're thinking about crypto. Steph is very crypto forward. And so it's great to have a partner who feels as excited about this space as we are.
Yeah, Brandon, I guess that would be my next question. What comes next, right? Because we've seen the use of NFTs already evolve a bit since just kind of auctioning off the digital rings that you guys did earlier. But I mean, where do you see it going to kind of enhance, I guess, the fan experience and really how big the whole industry could be?
It's a great question. What I like to say, and I'm quoting one of our owners, Peter Goober, when I say this is the beginning of the beginning. We did our drop earlier in the year. We've been looking at other opportunities, working with the NBA, who quite frankly deserves a lot of credit for being very ahead of this and enabling us and other teams to do NFTs earlier this year, and working with FTX, quite frankly, with their expertise in thinking about the best way to engage our fans, because that's really what this is about, is engaging our fans globally. And NFTs and cryptocurrency have become such a huge part of what we do. I mean, the community has evolved so much. So we want to continue to do things that are authentic to that community. One of the specifics that people talk about blockchain ticketing, which could be interesting. but if nothing else, to have digital collectible souvenirs that are NFTs. Like, could you do instead of a physical bobblehead, does that become an NFT? So there's, I think the opportunities are endless, and we're looking forward to exploring them with FTX in the years to come.
Brandon, when you think about the Warriors, they've kind of become known as Silicon Valley's team because where you are geographically, and you've had a long-term partnership with Oracle. You recently announced a platform to track player performance. I mean, you've really utilized that edge you have right within Silicon Valley to try and get an upper hand. And I wonder if you can speak to that, the tech integration within the team, and how you think that gives you an edge on the rest of the league.
Yeah, Akiko, I think that's well said. I mean, we are very fortunate to be in the Bay Area, and for us, it's just part of our DNA. You mentioned obviously FTX, you mentioned our partnership with Oracle, but we've got a good majority of our founding partners are technology companies. HPE, Ticketmaster is a technology company. You've got Verizon, you've got Ring Central, Google Cloud. We can keep going on and on. So we're really fortunate to be in the Bay Area. And for us, just like any other company, we're always looking for an edge. So you have all these world-class Fortune 50 technology companies in the Bay Area. So being able to work with them to do things to help us on the court, to help us off the court, always focused on the fan experience. We feel very fortunate to be here in the Bay and to have these opportunities. And FTX, I think, fits right in. As Brett mentioned, another technology company that we're really excited to add to our partner roster. And because of the space they're in and this emerging market, as I would call it, we are really, really excited to see what we'll be able to do together for years to come.
And Brett, obviously, each time we have you on, there's a new partnership, something new always in sports. I assume that this probably isn't going to be the only team that you partner up with. I mean, what's kind of the long-term goal in building out now, as you said, the new NFT platform here at FTX in terms of where you want to see that go and how large of a role the NBA is going to play in it?
Yeah, NFT is an amazing emerging technology that obviously has its benefits for things like working with athletes on intellectual property and naming and likeness. There's a lot of other aspects to NFT and blockchain technology as well that we're excited to push into areas like gaming, esports. So this is just the beginning of how we're going to expand the platform. But in the area of sports and other areas of entertainment, we're continuing to look for different niches where we can partner with people who are going to help us expand our brand, help expand our reach, help prove out the technology in a lot of ways that we're ready for a lot of these partners to be able to build out these marketplaces, these platforms, but just looking for the right partners to help bring amazing products with us to the space.
Well, it's certainly good to have both of you on this announcement. Brandon Schneider, Warriors President and COO, and Brett Harrison, FTX US President. Brandon, we're going to have you back on to talk about the basketball side of things, with the Warriors having a really good year so far, but good to have both of you on. Coming up, we are staying in the crypto space with TeraWolf, the green Bitcoin mining platform, going public on the NASDAQ. We've got the founder and CEO joining us after the break. Before we go to break, though, step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in an ad-light experience. Check it out today at yahoofinance.com/plus. We'll be right back. green Bitcoin mining platform TeraWulf going public today. The Gwyneth Paltrow-backed company debuting on the NASDAQ under the ticker WULF, and you see shares there sliding in its debut. TeraWulf founder and CEO Paul Prager is joining us now to discuss, along with Yahoo Finance's Brian Sazi. Paul, congratulations on the debut. I know CEOs don't like to talk about the stock move, but I do have to ask you about it because it is down nearly 20% today. Bit of a tough go in your debut. What do you think investors are getting wrong?
I think it's a tough day, for tech in general, and I think that it's a new stock. People got to get to know us. I think they've got to get to appreciate our business plan, our ability to execute. We're in this for the long haul. It's not just about today.
Well, Paul, to that point, take us through a little bit what you do and what you're up to next year.
Sure. We're mining Bitcoin, and we're mining it primarily in 2 sites, and we're doing it in the most responsible way. We're about zero carbon emissions. So we'll have 6 exahash by June. We'll be that's bigger than anybody else that's out there today, and we're about zero carbon emissions. So we're going to be executing using renewables and nuclear power.
Paul, who do you view as your competitors in this space?
I think what's good for mining, what's good for Bitcoin is a very robust and vibrant mining community. But I think that we are mining 10.0. Again, we're very ESG oriented, not as an ideal, but as a practice. And we have unique ability to execute on the business plan because we've got 25 years of operational excellence in energy infrastructure. And at its core, Bitcoin mining is energy infrastructure.
Paul, thanks for coming on. Zach here. I've been talking with a few of these kind of green Bitcoin mining companies. Bitfarms is another one that comes to mind. They're up by about 170% on the year so far. They're also heavily investing in upping their power and energy in the mining space. How much does maybe the competition in the green mining space maybe increase costs as you see it? And I guess what separates TeraWulf as you go up against them?
Yeah, I think several things. Number one is scale. We have a pipeline see through to 800 megawatts in sites. Number two is, we're not just a bunch of folks who are looking for stranded electricity at inexpensive pricing, and we have miners on order. We have built energy infrastructure for the last 25 years. We have 15 members of our team that have been with us over 15 years. We have had hundreds of employees at power plants around the country and internationally as well. We understand energy infrastructure. So we understand how to source electricity, how to mitigate the risks of the procurement of electricity. We know how to put the infrastructure in the ground so we can get a mining operation at scale, up and running, as reliably and as quickly as possible. I think we're unique in that space. And from the ESG perspective, we're not only zero carbon emission as opposed to focused on carbon neutrality, but we've got a management team where ESG has not been an ideal, it's been our practice. Again, we have 5 of their 7 executive members of the team are women, all been with the company for over a decade. I think it speaks to where we are headed in terms of our likelihood for success.
Paul, can you expand on that scale you just talked about? We're talking about TeraWulf right now, but clearly within this space, we have seen an increasing awareness of the use of energy, especially as we've seen mining operations migrate out of China, expand here in the US. How easy is it from an infrastructure perspective and a cost perspective to be able to replicate the kind of footprint that you've established?
I don't think it's easy at all, and you've got the issue of time. Listen, Bitcoin is finite. You want to get there early, and you want to get there hard and fast. If you wanted to be mining today, you had to order switchgear and transformers 18 months ago. We did. So somebody could go find electricity, maybe procure some miners, tell everybody they want to be in the mining business, but they're not up and mining in the first quarter of next year. We are. Again, scale is an important element. And the third thing is, you have to understand how to procure electricity. If you're a fella and you bought down in Texas and you went through the blizzard there, then you realize what can happen to the grid. You have to understand what to do, how to mitigate risks for events like that. That's all we've ever done for the last 25 years. So I think there are other folks that are out there that are trying to mine Bitcoin, that are trying to do it in a socially responsible way, but not at the scale that we are. Finally, I would tell you, I think regulation is coming. We welcome that. When regulation comes, we think it will come in the form of a carbon tax. So I think that will be enabling and prove us yet again to be the least expensive mining operator out there.
Well, talk to us about that potential for a carbon tax. How do you think that would impact the Bitcoin community?
I think it will increase people's operating costs. We're going to be mining, we're making Bitcoin 5,500, right? And I think other folks that are out there mining at slightly higher prices or elevated prices to that are going to have to pay an additional cost when it comes to a carbon tax if they're not mining with zero carbon emissions. There's a big difference between carbon neutrality and zero carbon emissions. We're zero carbon emissions.
Yeah, and lastly, I guess the other thing that separates you guys from some other Bitcoin mining companies is the investors you've now brought on board. Not only Gwyneth Paltrow, but also Mindy Kaling, Lily Singh as well. I'm not sure if they're getting as deep into kind of the exahash equations here and trying to figure out how much energy and the cost you guys might have. But what does it maybe say having them on board about maybe mainstream adoption in Bitcoin and where the mining space is going?
Sure. We raised $200 million last week, a combination of debt and equity. The debt piece was the first covenant-like term loan done in the space. The equity came, and it came before we went public, so it was very, very special. We really and genuinely appreciate the confidence and faith that all the investors had. We think Gwyneth and Kinship is no different than any other savvy investor. These are sophisticated entrepreneurs. They want to see a return on their investment, but they recognize that there is a responsible way to mine Bitcoin, and that's why they invested in us. Personally, I really appreciate the fact that we have a group that's so socially responsible, demonstrating their confidence in our business plan. I think it says a lot. We're very excited about having them on board as partners.
That's interesting stuff to see, and obviously we'll be tracking things beyond just day one here. But Paul Prager, TerraWolf founder and CEO, appreciate you coming on here alongside Yahoo Finance's Brian Sozzi. Thanks again for the time. Going to take another quick break here on the show, but when we return, much more around the deals being made in Washington, D.C. as Joe Biden looks to get his final chapter of increased social spending through. Across the bridge, maybe some pushback from Senator Joe Manchin. We'll have the latest there in D.C. right after this. Welcome into Yahoo Finance Live as we cross the noon Eastern Time trading hour. I'm Zach Guzman alongside Akiko Fujita. Happy Tuesday, everybody. As we're seeing the markets sell off yet again, the Fed kicks off its two-day policy meeting. The Dow off by about 160 points. The S&P 500 just a few moments ago hitting a new session low, and the NASDAQ once again taking it off the chin, the biggest loser today, off close to about 2%. Plus, consumer camera company GoPro is scoring an upgrade from Wetbush. Going to have the analyst behind that call on today's call of the day, why she sees some big drivers for growth in place at the company. And the big bet being made on building out multi-sport mega league of pro women's sports teams, scoring a big sponsorship deal. The co-founder of the league, Athletes Unlimited, Jonathan Soros, will stop by for more on how it's advancing equality in sports. But first, of course, all eyes on what we're going to hear from Jay Powell and the Fed tomorrow as they wrap up their two-day policy meeting kicked off today. A lot of questions around inflation and what the interest rate hikes for next year might look like. Of course, after Jay Powell ditched the word transitory in his outlook on inflation. And for more on all that, I want to bring on John Trainer, People's United Advisors Chief Investment Officer, here with us today. And Mr. Trainer, appreciate you taking the time to chat. Obviously, I do not envy, I don't think anyone envies the position that Jay Powell is now in, trying to weigh the issues of what the latest Omicron variant could do to this recovery, and also, I guess, trying to mitigate some volatility we've seen from the market since he's kind of shifted off that transitory inflation stage. What do you make of maybe where the market's going to be looking for key items from Jay Powell, and what investors should expect in the couple days ahead?
Well, it certainly looks like, as you said, he's moved off transitory. And, you know, the investors are saying, okay, we know he needs to move faster. You know, we're anticipating a ramp up in the expectation on the cessation of tapering. The key issue is, does he get spooked? We don't believe he's spooked where he will have to move too fast. That would really upset the market. But, you know, we'll need to wait. We'll need to see what kind of language comes out. But a quickening of the pace is certainly in the cards, and it's certainly justified. But, you know, moving too fast and then moving too fast to raise rates, that would upset the market. So if we see a gradual increase, we're anticipating we're going to start to see rates increase, perhaps at the May meeting. We'd like to see it a little bit earlier, but that we start a measured increase in rates. I think that would soothe the market quite a bit. Right now, there's just too much uncertainty, and that's what you're seeing in the market.
That's just a very delicate balancing act that the Fed has to really try and come up with here. When you look at where the yields have moved in the bond market, what does that tell you about where the expectations lie and how realistic they are?
You know, one of the things that really has surprised us is the rapid flattening in the yield curve. I mean, we were above 100 basis points when, you know, the debate was, will it be Lael Brainerd or Jerome Powell? We anticipated if Powell gets reappointed that we would see a flattening. If Lael Brainerd came in, we were anticipating a slight steepening of the yield curve. I'd say it's the magnitude of the flattening of the yield curve, and then what is that telling us? You know, essentially, even though Chairman Powell has moved away from transitory, we believe the bond market is still saying inflation is transitory. By mid next year, we'll start to see some better numbers. So the bond market is still in the transitory camp. At least that's what we believe interest rates are telling us right now.
Yeah, I guess, you know, you have the estimation. We heard from Jay Powell before. Maybe it's going to change when he steps in like this time around. But it sounded like mid-2022 is when some of these supply issues around COVID might start to abate, his estimation. Maybe when you start to see some of the inflation pressures start to roll off as well. I do wonder, though, I guess, with Omicron now being added, whether or not that could kind of change things up around maybe the shift that a lot of people were expecting away from goods to more the services side of the economy. What that might do to kind of, I guess, the need for more stimulus out there too. Obviously, no one wants to go back to lockdown measures, but I guess where we're at in the recovery.
So, you know, you hit the nail on the head, and I'm just looking at our GDP forecast for the fourth quarter. And, you know, a few months ago, we were at about 5.5%. There were some people out there that were calling for 7, 8, 9% this quarter. the COVID variant, the Omicron variant, has really thrown a wrench into the works. What is going to happen with, and you hit the nail on the head, is the service side of the economy that's really, buffering the economy right now. Restaurants, movie theaters, and the rest. We need to get the services side of the economy moving, and that is starting with fits and starts. So our fourth quarter GDP, we're staying north of 5%, but boy, oh boy, I think you'll see some of those higher estimates start to come down as people get a little bit more concerned about the variant. You saw the headlines this morning that infections are back up again, which is not a very good sign. And we'll all be getting together for the holidays in a few weeks. That also could lead to some higher infections. So, our GDP forecast is up in the air right now.
On your forecast there, John, specifically on inflation, core PCE, you see it pulling back about 2.5% next year. When do you think we start to see some of that ease if you consider how high the levels are right now?
It's interesting. I made a presentation with the CEO of Stop and Shop, big supermarket chain in the Northeast. And he was talking about prices, and he said, beef and chicken, they're there. There's no supply shortage. The problem and what's causing the increase in prices is the fact that the butchers can't get enough people to process the meat. So it's not we're seeing the inflation. It's not a commodity-based inflation. It's a supply. It's a worker-based inflation. It's really causing the problems. So we don't believe we're going to start to really see inflation, subside until, probably the spring. But we think we're going to start to see some good numbers. We think we're the next several months, the CPI, the headline number, is going to be fairly high. But we think hopefully in the spring, it's really more a labor issue. If we get good labor news and more hiring, then I think you'll start to see inflation come down.
And John, lastly, how should investors be playing all that volatility, all that uncertainty right now? We've seen tech stocks, as I said, kind of hit today. That seems to have been the trend every time we start talking about more hawkish Fed. How would you maybe advocate investors should be protecting themselves as volatility is going to continue?
We debated that actually on our last week's investment call. This year we moved to more of a neutral stance. In 17, 18, and 19, we were overweight growth. Well, then starting in 2020, we said, let's move to a neutral. So we started to increase value, decrease growth. Right now, we're actually underweight tech. We're underweight some of the big names. If you see rates start to increase, let's say we're wrong about inflation slowing down, and let's say it really does spook the market, you're going to see a lot of pressure on the PE multiples of the big stocks. So what we've been doing is just continuing to move to more of the cyclical side of the portfolio, buy more industrials, and balance out the portfolio. I know there are some people out there saying, boy, there's some of the big tech stocks have off, and here's a buying opportunity. We don't believe so. We think the valuations are still pretty high, and we want to remain underweight those stocks and move more to financials. They're a little more attractively valued, and move more toward industrials.
All right, we'll see how it all goes. Of course, tomorrow, the big speech at the Fed could change all of this. John Schreiner, People's United Advisors Chief Investment Officer. Appreciate the time. Thanks again. Speaking of inflation, that does seem to be still top of mind for one key Democratic Senator, Joe Manchin, in the back and forth to sign on to Joe Biden's $2 trillion spending program. And the latest there, still uncommitted to getting the president's agenda across the finish line. And for more on that, I want to head out to Washington, D.C. Yahoo Finance's Jessica Smith. Jessica Smith bringing us the latest there on that front. Jessica.
Yeah, Zach, Democratic leaders want to get this roughly $2 billion spending package done before Christmas, but that is a very ambitious goal, especially when you have Senator Manchin, who is not yet sold on the bill. He did have a conversation with President Biden yesterday. They haven't said much about how that conversation went, but we know that Manchin has not yet committed to supporting the Build Back Better plan. He has raised concerns about the bill, about its impact on inflation and the deficit. He said anything is possible when he was asked if this bill could still pass before Christmas. He said that he is still engaged in these negotiations, but again, he didn't give much detail, and he's kind of leaving his fellow Democratic lawmakers wondering exactly what he wants from this bill, what they need to include or what they need to get rid of in order to secure his votes. They do need his vote. Of course, they need the vote of every single Democratic lawmaker to get this done. But even aside from the issues with Senator Manchin, there is still quite a bit of work that needs to be done on this bill. Democrats are waiting for guidance for what provisions, including some immigration measures, will be allowed under the rules for reconciliation, the fast track process that they're using to pass this with only Democratic votes. So there's still a lot of work to do in both crafting the actual bill and getting Senator Manchin on board. Zach and Keita.
I mean, just you mentioned where Senator Manchin stands right now. It's tough to believe that there's any additional information he's seeking, if it is really in fact about concerns around potential inflationary pressures that could build up as a result of this kind of spending.